Hey traders and investors, welcome back to the audiobook series How to Make Money in Stocks by the legendary William J. O'Neil, the man behind the powerful Can Slim strategy and founder of Investors Business Daily. Today, we're diving into chapters 14 to 20, where O'Neil moves beyond the basics and shows us how to protect our gains, avoid the common traps, and master the mindset of a winning trader. Chapter 14, When to Sell and Cut Your Losses Short. O'Neil drills into the discipline of selling, one of the most overlooked skills in trading. He teaches you to cut losses quickly, around 7–8%, and never let a small mistake turn into a disaster. Chapter 15, When to Sell and Take Your Profit. You've made gains, now what? O'Neil explains when to sell into strength and how to recognize when a stock has run its course. Timing here is key to locking in profits before trends reverse. Chapter 16, Should you diversify, hedge, or hold through corrections? This chapter challenges the traditional idea of diversification. O'Neil warns that too much diversification waters down your performance, and he suggests a more focused, strategic approach. Chapter 17, How to Read Charts Like a Pro and Improve Your Stock Picks. A deep dive into technical analysis. Learn how to read price and volume charts, spot breakout patterns, and avoid buying at the wrong time. Chapter 18, Learning from the Greatest Stock Market Winners. O'Neil studies the past to predict the future. He breaks down how top-performing stocks behave before their big moves, giving you a blueprint to spot the next leaders. Chapter 19, How Great Companies Manage Their Funds. Ever wondered how professional money managers operate? This chapter offers insights into institutional behavior and how smart money moves in and out of stocks, a vital clue for individual traders. Chapter 20, How You Can Make Money. Reading the daily financial news page, O'Neil teaches how to filter through the noise of financial media and find meaningful data. It's all about seeing what the market is actually telling you, not just what the headlines say. Key takeaway. These chapters are about mastery, learning not just how to buy right, but how to sell smart, manage risk, and develop the instincts of a winning trader. If you're serious about growing your account and developing your edge in the market, you don't want to miss this part of the book. Drop a comment below. What's been your biggest lesson so far from O'Neil's strategy? Don't forget to like, subscribe, and share this audiobook series with your fellow traders. Let's continue the journey to becoming more disciplined, focused, and profitable.
Part 3, Investing Like a Professional. Chapter 14, More Models of Great Stock Market Winners. Throughout this book, I've shown you and discussed many of the greatest winning stocks of the past. Now that you've been introduced to the Can Slim system of investing, you should know that we actually suggested some of these same companies to clients through our institutional services firm or bought them ourselves. Regardless of your current position in life or your financial standing, it's clearly possible for you to make your dreams come true using the Can Slim system. You may have heard or read about the thousands of individuals who have changed their lives using this book and Investors Business Daily. It really happens. And it can happen to you if you are determined and have an overpowering desire, no matter how large or small your account. As long as you make up your mind, work at it, and don't ever let yourself get discouraged. This chapter will introduce you to a few early examples of success using this system. There are many, many others. In addition, it will also introduce you to more of the great winning stocks since 1952. Study this chapter closely. You'll find these patterns repeat over and over again throughout time. If you learn to recognize them early, you could get in on some future big profits, even if it takes some time. Tracing the growth of a small account. In 1961, with $10 from each of my classmates at Harvard's Program for Management Development, PMD, we started the first PMD fund with the grand total of $850. It was mostly for fun. Each classmate began with one $10 share in the fund. Marshall Wolf, then with National Newark and Essex Bank, and later an executive vice president at Mid-Atlantic National Bank, had the thankless job of secretary-treasurer, keeping the records, informing the gang, and filing and paying taxes each year. I got the easy job of managing the money. It's an interesting account to study, because it proves you can start very small and still win the game if you stick with sound methods and give yourself plenty of time. On September 16, 1986, some 25 years later, after all prior taxes had been paid and with Marshall having later kept some money in cash, the account was worth $51,653.34. The profit, in other words, was more than $50,000, and each share was worth $518. That is nearly a 50-fold after-tax gain from less than $1,000 invested. The actual buy and sell records in the accompanying table illustrate in vivid detail the execution of the basic investment methods we have discussed up to this point. Note that while there were about 20 successful transactions through 1964, there were also 20 losing transactions. However, the average profit was around 20%, while the average loss was about 7%. If losses in Standard Colsman, Brunswick, and a few others had not been cut, later severe price drops would have caused much larger losses. This small cash account concentrated in only one or two stocks at a time. Follow-up buys were generally made if the security moved up in price. The account made no progress in 1962, a bad market year, but it was already up 139% by June 6, 1963, before the first Syntex buy was made. By the end of 1963, the gain had swelled to 474% on the original $850 investment. The year 1964 was lackluster. Worthwhile profits were made in 1965, 1966, and 1967, although nothing like 1963, which was a very unusual year. I won't bore you with 20 pages of stock transactions. Let me just say that the next 10 years showed further progress, despite losses in 1969 and 1974. Another period of interesting progress started in 1978 with the purchase of Dome Petroleum. All decisions beginning with Dome are picked up and shown in the second table. Dome offers an extremely valuable lesson on why most stocks sooner or later have to be sold. While it was bought, as you can see, at $77 and sold near $98, it eventually fell below $2. History repeated itself in 2000 and 2001, when many internet big winners like CMGI dropped from $165 to $1. Note also that the account was worn out of Pick and Save on July 6, 1982, at $15, but we bought it back at $18 and $19, even though this was a higher price, and made a large gain by doing so. This is something you will have to learn to do at some point. If you were wrong in selling, in a number of cases, you'll need to buy the stock back at higher prices. The U.S. Investing Championship. Another engaging example of the can slim principles being properly applied is the story of one of our associates, Lee Freestone. Lee participated in the U.S. Investing Championship in 1991 when he was just 24 years old. Using the can slim technique, he came in second for the year, with a result of 279%. In 1992, he gained a 120% return and again came in second. Lee was doing what David Ryan, another associate at the time, had done when he participated in the U.S. Investing Championship in prior years and won. The U.S. Investing Championship is not some paper transaction derby. Real money is used, and actual transactions are made in the market. Lee continued to invest successfully with even larger returns in the late 1990s. So if it is followed with discipline, the can slim system has been battle-tested successfully through thick and thin from 1961 to 2009. More examples of great winners to guide you. Graphs for an additional selected group of the greatest stock market winners follow. They are models of the most successful investments in the United States from 1952 through 2009. Study them carefully and refer to them often. They are further examples of what you must look for in the future. The thin, wavy line with RS at the end shown below the prices is a relative price strength line. When the line moves up, the stock is outperforming the market. All the models show the stock's chart pattern just before the point where you want to take buying action. If you think you're just looking at a bunch of charts, think again. What you are seeing are pictures of the price accumulation patterns of the greatest winning stocks just before their enormous price moves began. The charts are presented in 5 configurations: cup with handle pattern, cup without handle pattern, double bottom pattern, flat base pattern, and base on top of a base pattern. You need to learn to recognize these patterns. Chapter 15. Picking the best market themes, sectors, and industry groups. The majority of the leading stocks are usually in leading industries. Studies show that 37% of a stock's price movement is directly tied to the performance of the industry group the stock is in. Another 12% is due to strength in its overall sector. Therefore, roughly half of a stock's move is driven by the strength of its respective group. Because specific industry groups lead each market cycle, you can see how worthwhile it is to consider a stock's industry before making a purchase. For the purposes of this discussion, there are three terms we will use: sector, industry group, and subgroup. A sector is a broad grouping of companies and industries. These include, for example, basic industries or cyclicals, consumer goods and services, transportation, finance, and high technology. An industry group is a smaller, more specific grouping of companies. There normally are several industry groups within a sector. A subgroup is even more specific, dividing the industry group into several very precise subcategories. For example, if we were to look at Viacom, it could be described as follows: sector, leisure and entertainment industry; group, media; and subgroup, radio TV. For clarity and ease of use, industry group and subgroup names are generally combined, with the results simply being called industry groups. For example, the industry group for Viacom is known as media, radio, TV. Why track 197 industry groups? Why does IBD divide securities into 197 industry groups rather than, say, the smaller number of groups used by Standard and Poor's? It's simple, really. The stocks within a given sector do not all perform at the same rate. Even if a sector is outperforming other sectors, there may be segments of that sector that are performing extremely well and others that are lagging the market. It's important that you be able to recognize what industry group within the sector is acting the very best, since this knowledge can mean the difference between superior and mediocre results. Early in our study of the market, we realized that many of the investment services available at the time did not adequately dissect the market into enough industry groups. It was therefore difficult to determine the specific part of a group where the true leadership was. So we created our own industry groups, breaking down the market into 197 different subcategories, and providing you, the investor, with more accurate and detailed insights into the makeup of an industry. For example, the medical industry can be divided into hospital companies, generic drugs, dental, home nursing, genetics, biotech, and HMOs, plus a few other unique modern areas. How you can decide which industry groups are leading the market. When analyzing industries, we found that some are so small that signs of strength in the group may not be relevant. If there are only two small, thinly traded companies within a sub-industry, that's not enough to consider them a group. On the other hand, there are industries with too many companies, such as chemicals and savings and loans. This excessive supply does not add to these industries' attractiveness, unless some extremely unusual changes in industry conditions occur. The 197 industry groups mentioned earlier can be found each business day in Investor's Business Daily. There we rank each subgroup according to its 6-month price performance, so that you can easily determine which industry subgroups are the true leaders. Buyers operating on the undervalued philosophy love to do their prospecting in the worst-ranked groups. But analysis has shown that, on average, stocks in the top 50 or 100 groups perform better than those in the bottom 100. To increase your odds of finding a truly outstanding stock in an outstanding industry, concentrate on the top 20 groups and avoid the bottom 20. Both Investor's Business Daily and the Daily Graph's online charting services offer an additional, proprietary source of information to help you determine whether the stock you're thinking about owning is in a top-flight industry group. The industry group relative strength rating assigns a letter grade from a plus to E to each publicly traded company we follow, with a plus being best. A rating of a plus, A, or A means the stock's industry group is in the top 24% of all industry groups in terms of price performance. Every day, I also quickly check the new price highs list in IBD. It is uniquely organized in order of the broad industry sectors with the most individual stocks that made new price highs the previous day. You can't find this list in other business publications. Just note the top 6 or so sectors, particularly in bull markets. They usually pick up the majority of the real leaders. Another way you can find out what industry groups are in or out of favor is to analyze the performance of a mutual fund family's industry funds. Fidelity Investments, one of the nation's successful mutual fund managers, has more than 35 industry mutual funds. A glance at their performance provides yet another excellent perspective on which industry sectors are doing better. I've found it worthwhile to note the 2 or 3 Fidelity industry funds that show the greatest year-to-date performance. This is shown in a small special table in IBD every business day. For William O'Neil plus Co.'s institutional clients, a weekly data graph service is provided that arranges the 197 industry groups in order of their group relative price strength for the past 6 months. Stocks in the strongest categories are shown in Volume 1 of the O'Neil database books, and stocks in the weaker groups are in Volume 2. During a time period in which virtually all daily newspapers, including the Wall Street Journal, significantly cut the number of companies they covered in their main stock tables every business day, and or dramatically reduced the number of helpful key data items shown daily for each stock, here's what Investors Business Daily did. IB's stock tables are now organized in order of performance, from the strongest down to the weakest of 33 major economic sectors, such as medical, retail, computer software, consumer, telecom, building, energy, internet, banks, and so on. Each sector combines NYSE and NASDAQ stocks, so you can compare every stock available in each sector to find the best stocks in the best sectors based on a substantial number of key variables. IBD now gives you 21 vital time-tested facts on 2,500 leading stocks in its stock tables each business day, far more than most other daily newspapers in America. These 21 facts are: 1. An overall composite ranking from 1 to 99, with 99 best. 2. An earnings per share growth rating comparing each company's last 2 quarters and last 3 years' growth with those of all other stocks. A 90 rating means the company has outperformed 90% of all stocks. 3. A relative price strength rating comparing each stock's price change over the last 12 months with those of all other stocks. Better firms rate 80 or higher on both EPS and RS. 4. A rating comparing a stock's sales growth rate, profit margins, and return on equity to those of all other stocks. 5. A highly accurate proprietary accumulation distribution rating that uses a price and volume formula to gauge whether a stock is under accumulation, buying, or distribution, selling in the last 13 weeks. A denotes heavy buying, E indicates heavy selling. 6 and 7. Volume percent change tells you each stock's precise percentage change above or below its average daily volume for the past 50 days along with its total volume for the day. 8 and 9. The current and recent relative performance of each stock's broad industry sector. 10-12. Each stock's 52-week high price, closing price, and change for the day. 13-21. Price-earnings ratio, dividend yield, if the company repurchased its stock in the last year, if the stock has options, if company earnings will be reported in the next 4 weeks, if the stock was up 1 point or more or made a new high. If the stock was down 1 point or more or made a new low. If the stock had an IPO in the last 8 years and has an EPS and RS rating of 80 or higher, and if a recent IBD story on the company is archived at Investors.com. Not only does IBD follow more stocks and provide more vital data, but the table print size is much larger and easier to read. As of this writing in February 2009, the medical sector is number 1. These ratings will adjust and change as the weeks and months go by and market conditions, news, and data change. I believe these significant and relevant data for serious investors, regardless of whether they are new or experienced, are light years ahead of the data provided by most of IB's competitors. Considering some of the seeming disasters coming out of Wall Street and the big city banking community in 2008, we believe we are and have been providing the American public, with our many books like the one you're reading, home study courses, more than 1,000 seminars and workshops nationwide, plus Investors Business Daily, a source of relevant, sound education, help, and guidance in an otherwise complex but key area that much of the investment community and Washington may not have always have handled as well. The vital importance of following industry trends. If economic conditions in 1970 told you to look for an improvement in housing and a big upturn in building, what stocks would you have included in your definition of the building sector? If you had acquired a list of them, you'd have found that there were hundreds of companies in that sector at the time. So how would you narrow down your choices to the stocks that were performing best? The answer: look at them from the industry group and subgroup levels. There were actually 10 industry groups within the building sector for investors to consider during the 1971 bull market. That meant there were 10 different ways you could have played the building boom. Many institutional investors bought stocks ranging from lumber producer Georgia-Pacific to wallboard leader U.S. Gypsum to building products giant Armstrong Corp. You could have also gone with Masco in the plumbing group, a home builder like Kaufman and Broad, building material retailers and wholesalers like Standard Brands Paint and Scotty's Home Builders, or mortgage insurers like MGIC. Then there were manufacturers of mobile homes and other low-cost housing, suppliers of air conditioning systems, and makers and sellers of furniture and carpets. Do you know where the traditional building stocks were during 1971? They spent the year in the bottom half of all industry groups, while the newer building-related subgroups more than tripled. The mobile home group crossed into the top 100 industry groups on August 14, 1970, and stayed there until February 12, 1971. The group returned to the top 100 on May 14, 1971, and then fell into the bottom half again later the following year, on July 28, 1972. In the prior cycle, mobile homes were in the top 100 groups in December 1967 and dropped to the bottom half only in the next bear market. The price advances of mobile home stocks during these positive periods were spellbinding. Redmond Industries zoomed from a split, adjusted $6 to $56, and Skyline moved from $24 to what equaled $378 on a per-split basis. These are the kind of stocks that charts can help you spot if you learn to read charts and do your homework. We study the historical model of all these past great leaders and learn from them. From 1978 to 1981, the computer industry was one of the leading sectors. However, many money managers at that time thought of the industry as consisting only of IBM, Burroughs, Sperry Rand, Control Data, and the like. But these were all large mainframe computer manufacturers, and they failed to perform during that cycle. Why? Because while the computer sector was hot, older industry groups within it, such as mainframe computers, were not. Meanwhile, the computer sector's many new subdivisions performed unbelievably. During that period, you could have selected new, relatively unknown stocks from groups such as Minicomputers, Prime Computer, Microcomputers, Commodore International, Graphics, Computer Vision, Word Processors, Wang Labs, Peripherals, Verbatim, Software, Cullinane Database, or Time-Sharing Electronic Data Systems. These fresh new entrepreneurial winners increased 5 to 10 times in price. That's the new in can slim. No U.S. administration can hold back America's inventors and innovators for very long unless it is really stifling business and the country. During 1998 and 1999, the computer sector led again, with 50 to 75 computer-related stocks hitting the #1 spot on Investors Business Daily's new high list almost every day for more than a year. If you were alert and knew what to look for, it was there to be seen. It was Siebel Systems, Oracle, and Veritas in the enterprise software group, and Brocade and Emulex among local network stocks that provided new leadership. The computer internet group boomed with Cisco, Juniper, and BAE Systems, and EMC and Network Appliance had enormous runs in the memory group, while the formerly leading personal computer group lagged in 1999. After their tremendous increases, most of these leaders then topped in 2000 along with the rest of the market. Many new subgroups have sprung up since then, and many more will spring up in the future as new technologies are dreamed up and applied. We are in the computer, worldwide communications, and space age. New inventions and technologies will spawn thousands of new and superior products and services. We're benefiting from an endless stream of ingenious offshoots from the original mainframe industry. And in the past, they came so fast we had to update the various industry categories in our database more frequently just to keep up with them. There is no such thing as impossible in America's free enterprise system. Remember, when the computer was first invented, experts thought the market for it was only two, and one would have to be bought by the government. And the head of digital equipment later said he didn't see why anyone would ever want a computer in her home. When Alexander Graham Bell invented the telephone, he was struggling and offered a half interest in the telephone to the president of Western Union, who replied, "What could I do with an interesting toy like that?" Walt Disney's board of directors, his brother, and his wife didn't like Walt's idea to create Disneyland. In the bull market from 2003 to 2007, two of the best leaders in 1998 and 1999, America Online and Yahoo, failed to lead, and new innovators like Google and Priceline.com moved to the head of the pack. You have to stay in phase with the new leaders in each new cycle. Here's a historical fact to remember. Only one of every 8 leaders in a bull market reasserts itself as a leader in the next bull market. The market usually moves on to new leadership, and America keeps growing, with new entrepreneurs offering you, the investor, new opportunities. A look at industries of the past and what's coming in the future. At one time, computer and electronic stocks may outperform. In another period, retail or defense stocks will stand out. The industry that leads in one bull market normally won't come back to lead in the next, although there have been exceptions. Groups that emerge late in a bull phase are sometimes early enough in their own stage of improvement to weather a bear market and then resume their advance, assuming leadership when a new bull market starts. These were the leading industry groups in each bull market from 1953 through 2007. As you might imagine, industries of the future create gigantic opportunities for everyone. While they occasionally come into favor, industries of the past offer less dazzling possibilities. There were a number of major industries, mainly cyclical ones, that were well past their peaks as of 2000. Many of them, however, came back from a poor past to stronger demand from 2003 to 2007 as a result of the enormous demand from China, as it copied what the United States did in the early 1900s, when we created and built an industrial world leader. China, with its long border with Russia, witnessed firsthand the 70-year-old communist Soviet Union implode and disappear into the ash heap of history. The Chinese learned from the enormous growth and higher standard of living created in America that its model had far more potential for the Chinese people and their country. Most Chinese families want their one child to get a college education and learn to speak English. Families in India have many of the same aspirations. Here is a list of these old line industries. 1. Steel 2. Copper 3. Aluminum 4. Gold 5. Silver 6. Building materials 7. Autos 8. Oil 9. Textiles 10. Containers 11. Chemicals 12. Appliances 13. Paper 14. Railroads and railroad equipment 15. Utilities 16. Tobacco 17. Airlines 18. Old line department stores industries of the present and future might include 1. Computer medical software 2. Internet and e-commerce 3. Laser technology 4. Defense electronics 5. Telecommunications 6. New concepts in retailing 7. Medical, drug, and biomedical genetics 8. Special services 9. Education. Possible future groups might include wireless, storage area networking, person-to-person networking, network security, palm-top computers, wearable computers, protomics, nanotechnology, and DNA-based microchips. Tracking NASDAQ and NYSE stocks together is key. Groups that emerge as leaders in a new bull market cycle can be found by observing unusual strength in one or two NASDAQ stocks and relating that strength to similar power in a listed stock in the same group. Initial strength in only one listed stock is not sufficient to attract attention to a category, but confirmation by one or two kindred NASDAQ issues can quickly steer you to a possible industry recovery. You can see this by looking at the accompanying charts of Home Builder Centex's OTC traded stock from March to August of 1970, and of Home Builder Kaufman and Broad's NYSE listed shares from April to August of the same year. 1. Centex's relative strength in the prior year was strong, and it made a new high 3 months before the stock price did. 2. Earnings accelerated by 50% during the June 1970 quarter. 3. The stock was selling near an all-time high at the bottom of a bear market. 4. A strong Centex base coincided with the base in Kaufman and Broad. In the 2003 bull market, Coach Co. was a NYSE-listed stock that we found on our weekly review of charts as it broke out of its base on February 28. It gave another buy point on April 25 when it bounced off its 10-week moving average price line. However, this time the new bull market had begun in earnest after a major market follow-through day in the market averages. And on April 25, 2 other leaders in the retail clothing industry, Urban Outfitters, Urban, and Decker's Outdoor, Deck, broke out at the same time as the Coach move. Now, there was plenty of evidence, from 1 NYSE stock and 2 NASDAQ issues in the same industry group, of a powerful new group coming alive for the new bull market that had just started. This is one more reason IBD's NYSE and NASDAQ tables are combined and the stocks are shown by industry sectors. You can spot all the leaders more easily when they're together in a group. A key stock's weakness can spill over to the group. Grouping and tracking stocks by industry group can also help you get out of weakening investments faster. If, after a successful run, 1 or 2 important stocks in a group break seriously, the weakness may sooner or later wash over into the remaining stocks in that field. For example, in February 1973, weakness in some key building stocks suggested that even stalwarts such as Kaufman and Broad and MGIC were vulnerable, despite the fact that they were holding up well. At the time, fundamental research firms were in unanimous agreement on MGIC. They were sure that the mortgage insurer had earnings gains of 50% locked in for the next 2 years, and that the company would continue on its merry course, unaffected by the building cycle. The fundamental stock analysts were wrong. MGIC later collapsed along with the rest of the deteriorating group. In the same month, ITT traded between $50 and $60, while every other stock in the conglomerate group had been in a long decline. The 2 central points overlooked by 4 leading research firms that recommended ITT in 1973 were that the group was very weak and that its relative strength was trending lower, even though the stock itself was not. Oil and oil service stocks top in 1980-1981. This same washover effect within groups was also seen in 1980-1981. After a long advance in oil and oil service stocks, our early warning criteria caused our institutional services firm to put stocks such as Standard Oil of Indiana, Schlumberger, Gulf Oil, and Mobil on the sell-avoid side, meaning we felt they should be avoided or sold. A few months later, data showed that we had turned negative on almost the entire oil sector, and that we had seen the top in Schlumberger, the most outstanding of all the oil service companies. Based objectively on all the historical data, you had to conclude that, in time, the weakness would wash over into the entire oil service industry. Therefore, we also added equities such as Hughes Tool, Western Co. of North America, Rowan Companies, Varco International, and NL Industries to the sell-avoid list, even though the stocks were making new price highs and showed escalating quarterly earnings, in some cases by 100% or more. These moves surprised many experienced professionals on Wall Street and at large institutions, but we had studied and documented how groups historically had topped in the past. Our actions were based on historical facts and sound principles that had worked over decades, not on analysts' personal opinions or possibly one-sided information from company officials. Our service is totally and completely different from that of all Wall Street research firms because we do not hire analysts, make buy or sell recommendations, or write any research reports. We use supply and demand charts, facts, and historical precedents that now cover all common stocks and industries from the 1880s through 2008. The decision to suggest that clients avoid or sell oil and oil service stocks from November 1980 to June 1981 was one of our institutional firm's more valuable calls at the time. We even told a Houston seminar audience in October 1980 the entire oil sector had topped. A full 75% of those in attendance owned petroleum stocks. They probably didn't believe a word we said. We were not aware at the time, or even in the several months following, of any other New York Stock Exchange firm that had taken that same negative stand across the board on the energy and related drilling and service sectors. In fact, the exact opposite occurred. Because of such decisions, William O'Neil plus Co. became a leading provider of historical precedent ideas to many of the nation's top institutional investors. Within a few months, all these stocks began substantial declines. Professional money managers slowly realized that once the price of oil had topped and the major oil issues were under liquidation, it would be only a matter of time before drilling activity would be cut back. In the July 1982 issue of Institutional Investor magazine, 10 energy analysts at 8 of the largest and most respected brokerage firms took a different tack. They advised purchasing these securities because they appeared cheap and because they had had their first correction from their price peak. This is just another example of how personal opinions, even if they come from the highest research places or bright young MBAs from outstanding Ivy League universities, are quite often wrong when it comes to making and preserving money in the stock market. The same situation occurred again in 2008 when we first put Schlumberger on the sell avoid list at $100 on July 3. Schlumberger, the quality leader in the oil sector, closed below its 10-week moving average every week as it began its slow, steady topping process along with other oil stocks. Many institutions, on analysts' recommendations, bought the oils too soon on the way down because they seemed such a bargain. Meanwhile, oil itself was midway in the process of collapsing from $147 a barrel to $35 to $50. In August 2000, a survey showed many analysts had high-tech stocks as strong buys. 6 months later, in one of the worst markets in many years, roughly the same proportion of analysts still said tech stocks were strong buys. Analysts certainly missed with their opinions. Only 1% of them said to sell tech stocks. Opinions, even by experts, are frequently wrong. Markets rarely are. So learn to read what the market is telling you and stop listening to ego and personal opinions. Analysts who don't understand this are destined to cause some substantial losses for their clients. We measure historical market facts, not personal opinions. We do not visit or talk to any companies, have analysts to write research reports, or have or believe in inside information. Nor are we a quantitative firm. We tell our institutional subscribers who have teams of fundamental analysts to have their analysts check with their sources, and the companies concerned to decide which of our rather unusual ideas based on historical precedent may be sound and right fundamentally, and which are possibly not right. Institutions have always had a prudent personal responsibility for the stocks they invest in. We make our mistakes too, because the stock market is never a certainty. But when we make mistakes, we correct them rather than sit with them. The bowling boom tops in 1961. Beginning in 1958 and continuing into 1961, Brunswick stock made a huge move. The stock of AMF, which also made automatic pin spotters for bowling alleys, gyrated pretty much in unison with Brunswick. After Brunswick peaked in March 1961, it rallied back to $65 from $50, but for the first time, AMF did not recover along with it. This was a tip-off that the entire group had made a long-term top, that the rebound in Brunswick wasn't going to last, and that the stock, as great as it had been, should be sold. One practical, common-sense industry rule is to avoid buying any stock unless its strength and attractiveness are confirmed by at least one other important stock in the same group. You can get away without such confirmation in a few cases where the company does something truly unique, but these situations are very few in number. From the late 1980s to the late 1990s, Walt Disney fell into this category. a unique high-quality entertainment company rather than just another filmmaker in the notoriously unsteady, less reliable movie group. Two other valuable concepts turned up as we built historical models in the stock market. The first we named the follow-on effect, and the second, the cousin stock theory. The follow-on effect, sometimes, a major development takes place in one industry and related industries later reap follow-on benefits. For example, in the late 1960s, the airline industry underwent a renaissance with the introduction of jet airplanes, causing airline stocks to soar. A few years later, the increase in air travel spilled over to the hotel industry, which was more than happy to expand to meet the rising number of travelers. Beginning in 1967, hotel stocks enjoyed a tremendous run. Loews and Hilton were especially big winners. The follow-on effect in this case was that increased air travel created a shortage of hotel space. When the price of oil rose in the late 1970s, oil companies began drilling like mad to supply the suddenly pricey commodity. As a result, higher oil prices fueled a surge not only in oil stocks in 1979, but also in the stocks of oil service companies that supplied the industry with exploration equipment and services. The roaring success of small and medium-sized computer manufacturers during the 1978-1981 bull market created follow-on demand for computer services, software, and peripheral products in the market resurgence of late 1982. As the Internet took off in the mid-1990s, people discovered an insatiable demand for faster access and greater bandwidth. Soon networking stocks surged, with companies specializing in fiber optics enjoying massive gains in their share prices. The cousin stock theory: if a group is doing exceptionally well, there may be a supplier company, a cousin stock, that's also benefiting. As airline demand grew in the mid-1960s, Boeing was selling a lot of new jets. Every new Boeing jet was outfitted with chemical toilets made by a company called Monogram Industries. With earnings growth of 200%, Monogram stock had a 1,000% advance. In 1983, Fleetwood Enterprises, a leading manufacturer of recreational vehicles, was a big winner in the stock market. Techstone was a small cousin stock that supplied vinyl-clad paneling and hollow-core cabinet doors to RV and mobile home companies. If you notice a company that's doing particularly well, research it thoroughly. In the process, you may discover a supplier company that's also worth investing in. Basic conditions change in an industry. Most group moves occur because of substantial changes in industry conditions. In 1953, aluminum and building stocks had a powerful bull market as a result of pent-up demand for housing in the aftermath of the war. Wallboard was in such short supply that some builders offered new Cadillacs to gypsum board salespeople for just letting them buy a carload of their product. In 1965, the onrush of the Vietnam War, which was to cost $20 billion or more, created solid demand for electronics used in military applications and defense during the war. Companies such as Fairchild Camera climbed more than 200% in price. In the 1990s, discount brokerage firms continued to gain market share relative to full-service firms as investing became more and more mainstream. At that time, a historical check proved that Charles Schwab, one of the most successful discount brokerage firms, had performed as well as market leader Microsoft during the preceding years, a valuable fact few people knew then. Watch for new trends as they develop. In our database research, we also pay attention to the areas of the country where corporations are located. In our ratings of companies as far back as 1971, we assigned extra points for those headquartered in Dallas, Texas, and other key growth or technology centers, such as California's Silicon Valley. Recently, however, California's high-cost, high-tax business environment has caused a number of companies to move out of the state to Utah, Arizona, and the Southwest. Shrewd investors should also be aware of demographic trends. From data, such as the number of people in various age groups, it's possible to predict potential growth for certain industries. The surge of women into the workplace and the gush of baby boomers help explain why stocks like the Limited, Dress Barn, and other retailers of women's apparel soared between 1982 and 1986. It also pays to understand the basic nature of key industries. For example, high-tech stocks are 2.5 times as volatile as consumer stocks, so if you don't buy them right, you can suffer larger losses. Or if you concentrate most of your portfolio in them, they could all come down at the same time. So, be aware of your risk exposure if you get over-concentrated in the volatile high-tech sector or any other possibly risky area. Sometimes defensive groups may flash general market clues. It's also important for investors to know which groups are defensive in nature. If after a couple of bull market years, you see buying in groups such as gold, silver, tobacco, food, grocery, and electric and telephone utilities, you may be approaching a top. Prolonged weakness in the utility average could also be signaling higher interest rates and a bear market ahead. The gold group moved into the top half of all 197 industries on February 22, 1973. Anyone who was ferreting out such information at that time got the first crystal-clear warning of one of the worst market upheavals up to that point, since 1929. 60% or more of big winners are part of group moves. Of the most successful stocks from 1953 through 1993, nearly 2 out of 3 were part of group advances. So remember, the importance of staying on top of your research and being aware of new group movements cannot be overestimated. Chapter 16: How I Use IBD to Find Potential Winning Stocks. Why we created Investors Business Daily. For decades, professional money managers were the only ones who had access to the in-depth data that are critical to finding winning stocks. In effect, they had a monopoly on relevant investment information. That's why I started Investors Business Daily in April 1984, to bring the needed information to all investors, small or large, new or experienced. Known for its investing capabilities as far back as the early 1960s, William O'Neil + Co. built the first computerized daily stock market database in the United States to track and compare stock performance. Detailed tracking uncovered key insights into what produces stock market winners, particularly their characteristics, before they make a major price move. Much of this information is now available through Investors Business Daily, which offers everyone, professional and individual investors alike, a better opportunity to grow and profit from the detailed data. Because our primary concern is understanding and interpreting the national economy using our comprehensive database, Investors Business Daily is a vital information provider first and a newspaper second. If you're serious about becoming a more successful investor, it is positively within your grasp. If you can commit to studying the time-tested, historically proven strategies outlined in this book, being disciplined, and focusing on daily and weekly learning, you're more than halfway there. IBD's proprietary research tools are the other half of the equation. For many of you, this means familiarizing yourself with data, methods, and concepts very different from those you're accustomed to hearing, seeing, and using. For example, according to our historical study of all the greatest winning stocks, if you'd been relying on P/E ratios, you would have missed almost every major winner for decades. The information in IBD is based on the characteristics of the most successful companies of all time before their major price moves. Following these valid model examples of success has helped me and many others achieve success since the 1960s. Investors Business Daily began in April 1984 with only 15,000 subscribers. In the years prior to our launch, the Wall Street Journal grew steadily to reach its peak of 2.1 million domestic circulation by our 1984 introduction date. Since that time, Investors Business Daily has increased its market share over many years. In key high-population areas such as Southern California, Florida, and Long Island, New York, IBD has a larger than normal number of readers. While many of our readers were former Wall Street Journal subscribers, there is little current duplication of readership, since several surveys show that only 16% of IBD subscribers also take the journal. How Investors Business Daily is different. So what is it exactly that distinguishes IBD from other sources? Let's take a closer look. IBD makes it easier to search for winning stocks. With more than 10,000 publicly traded stocks to choose from, IBD provides performance lists and proven proprietary fundamental and technical ratings and rankings that help you narrow your choices to only the very best opportunities. It offers quicker, easier, and more accurate and reliable ways to interpret the general market. The key elements of the day's trading action are explained in IBD's The Big Picture column to give you a sound perspective on the health of the overall market and improve your timing of buy and sell decisions. In tough markets like 2000-2003 and 2007-2009, this is critical information. It provides you valuable investing education and support. IBD's entire focus is on solid database research and extensive historical model building to serve as examples facts, not personal opinions. There are a multitude of sources outlined in this chapter that can help you learn and understand how the market really works, based on years of historical precedent. A new, better way to find winning stocks. At Investors Business Daily, we've developed an entirely different way to search for winning stocks. That's because after more than 4 decades of historical research, we know top stocks show definite signs of strength before they become exceptional winners. That confuses people who prefer a bargain the low-priced, unknown stocks they hope will take off and surprise us all. As we've said, cheap stocks are cheap for a reason. They have deficiencies that don't allow the stock to progress. For a stock to move higher, it needs earnings growth and strong sales, plus several other factors that demonstrate it's emerging as a new leader. If you catch such a stock at the early stages, you will be able to capitalize on its enormous progress. Remember, the greatest winners of all time, like Cisco Systems and Home Depot, began their biggest price moves after they'd gained leadership in earnings, sales growth, and the other factors described in this book. Some of the critical data you need to start your search can be found in the IBD stock tables. The unique IBD ratings are a way to spot potential winners before they take off, so it's important that you review these ratings daily. IBD stock tables are different from anything you'll see anywhere else. Proprietary SmartSelect corporate ratings speak volumes about each stock's performance and how a stock compares to all the others in our database. The elements in these ratings, which are numbered 1 through 6 in the accompanying chart, are explained in detail here. The IBD SmartSelect corporate ratings. The one line of information in the IBD SmartSelect corporate ratings is much more powerful and meaningful than anything you'll find in standard price tables. These ratings, which have been proven to be the most predictive measurements of a stock's possible future value, will narrow your search from over 10,000 stocks to the top investment prospects. You'll find these ratings are like a condensed statistical summary financial report that looks at the fundamental strength or weakness of a stock. They are also a well-rounded evaluation of each company's general health. Most importantly, along with daily and/or weekly charts, these ratings will help you find better stocks. Let's examine each element. Earnings per share rating indicates a company's relative earnings growth rate. Strong earnings growth is essential to a stock's success and has the greatest impact on its future price performance. The first absolutely vital component of the SmartSelect ratings is the earnings per share EPS rating, which is labeled 1 in the chart. The EPS rating calculates the growth and stability of each company's earnings over the last 3 years, giving additional weight to the most recent few quarters. The result is compared with those of all other common stocks in the price tables and is rated on a scale from 1 to 99, with 99 being the best. Example: an EPS rating of 90 means that a company's bottom-line earnings results over the short and the long term are in the top 10% of the roughly 10,000 stocks being measured. This one number gives you the relative earnings performance for publicly held companies and the possible prospects for their stocks. It's an objective measure you can use to compare the audited results of one company to those of any other. For example, the earnings growth of IBM to that of Hewlett-Packard, Lockheed, Lowe's companies, Walmart, or Apple. Earnings estimates are not used in the calculation because they are personal opinions, which, as you know, might be wrong and do change. Since earnings power and earnings growth are the most basic measures of a company's success, the EPS rating is invaluable for separating the true leaders from the poorly managed, deficient, and lackluster companies in today's tougher worldwide competition. The EPS rating is also more meaningful than the widely followed Fortune 500 lists that rank corporations by company size. Size alone rarely guarantees innovation, growth, or profitability. Large companies that are between 50 and 100 years old may have a well-known brand image, but often they are losing market share to younger, more innovative companies that have created newer, better products. Consider the decline of some of our auto companies and their unions: Alcoa, Eastman Kodak, International Paper, Xerox, CBS, Gannett, and Citigroup. Relative price strength rating shows emerging price leaders. Since we've learned that the best stocks are superior price performers even before their major moves, you should look for stocks with price leadership. The relative price strength (RS) rating shows you which stocks are the best price performers, measuring a stock's performance over the previous 12 months. That performance is then compared with the performance of all other publicly traded companies and given a 1 to 99 rating, with 99 being best. Look at the column labeled 2 in the chart example. Example: an RS rating of 85 means the stock's price movement has outperformed 85% of all other common stocks in the last year. The greatest winning stocks since 1952, and even much earlier, showed an average RS rating of 87 when they broke out of their first price consolidation areas, bases. In other words, the greatest stocks were already outperforming nearly 90%, or 9 out of 10, of all other stocks in the market before they made their biggest price gains. Even in poor markets, a relative price strength rating that breaks below 70 can forewarn you of a possible problem situation. On the sell side, however, we have a ton of sell rules that can lead you to sell most stocks sooner and more effectively than relying on a deteriorating relative strength line that is calculated using the past 12 months' price action. When you compare these fact-based performance ratings to the old, unscientific methods, which were typically based on faulty personal opinions, beliefs, academic theories, stories, promotions, egos, tips, and rumors, it becomes inarguable that IBD's unique factual ratings can give you a more clear-headed edge up in the complex market. You need both strong EPS and strong RS ratings. The implications of both the earnings per share rating and the relative price strength rating are considerable. So far, you've been able to determine the top leaders in earnings and relative price strength. The vast majority of superior stocks will rank 80 or higher on both the EPS and the RS ratings before their major moves. Since one of these is a fundamental measurement and the other is a marketplace valuation, insisting on both numbers being strong should, in positive markets, materially improve your selection process. Of course, there's no guarantee that a company's terrific past or current record won't suddenly turn sour in the future. That's why you must always use a loss-cutting strategy, such as the sell rules discussed in chapters 10 and 11. It's also prudent and essential to check the stock's daily or weekly chart to see if it's in a proper base, or if it's extended in price too far above its most recent area of consolidation. For a review of common chart patterns to watch for, refer back to Chapter 2. As previously discussed, models of the best-performing companies over the last century showed that earnings growth for the last 3 years and percent increase in earnings per share for the latest 2 or 3 quarters were the two most common fundamental characteristics. Having hard data like these available to you naturally begs the question, why would you ever invest your hard-earned dollars in a sluggish stock that sports a 30 EPS rating or a 40 RS rating when there are literally thousands of companies with higher ratings, including hundreds with superlative numbers? It's not that companies with poor ratings can't perform. It's just that a greater percentage of them turn out to be disappointments. Even when a low-rated company has a decent price move, you'll find that the better-rated stocks in the same industry have probably done much better. In a way, the combination of the EPS rating and the RS rating is similar to A.C. Nielsen's viewer ratings for TV shows. Who wants to continue sponsoring a TV show that gets poor ratings? Now, pretend for a minute you're the manager of the New York Yankees. It's off-season, and you're going to pick new players for next year's team. Would you trade for, recruit, or sign only .200 hitters? Or would you select as many .300 hitters as possible? The .300 hitters cost you more money, their P and E's are higher, and they sell nearer to their price high. It's true the .200 hitters are available at a cheaper price, but how many games will you win with 9 players in your lineup, averaging .200? When the bases are loaded in the 9th inning and the score is tied, who would you rather see step up to the plate, a .200 hitter or a .300 hitter? How often does an established .200 hitter blossom into a batting champion? Selecting and managing a portfolio of stocks is no different from baseball when it comes to performance. To win consistently and finish first in your division, you need a roster of the very best players available, those with proven records of excellence. You won't do as well in your investing if you insist on buying poorer performers and cheaper stocks, or those with some positive features but 3 or 4 little-noticed defects, in the hope of discovering a winner. Every little detail separates winners from losers. Hope never works in the market unless you start with a high-quality stock that's begun to build steam. It's the steam, earnings, sales, and price and volume strength that is the key prerequisite for future growth. Don't be fooled by bargain basement thinking or buy stocks on the way down because they look cheap. Replace your hopes and fallible personal opinions with proven, measurable facts. It's also interesting to note that these practical, no-nonsense ratings have helped to wake up corporate board members and put pressure on management teams producing second-rate results. A consistently low IBD relative performance rating should be a serious wake-up call to any top management team or board of directors. Strong sales, profit margins, and return on equity are a big clue. Cutting costs may boost a company's earnings for a quarter or two, but powerful, sustained profit increases require healthy sales growth. It's also important to buy companies that make the most of their sales growth. How much profit do they generate from each dollar of sales? How well do they use their capital? The sales plus profit margins plus return on equity, SMR registered rating, combines these important fundamental factors and is the fastest way to identify truly outstanding companies with real sales growth and profitability. These are factors that are widely followed by the better analysts and portfolio managers. The SMR rating is on an A to E scale, with an B being the best. In most cases, you want to avoid stocks with an SMR rating of D or E. See the column labeled 3 on the chart. Example, an SMR rating of A puts a stock in the top 20% of companies in terms of sales growth, profitability, and return on equity. During the brief rally that followed the Nasdaq's bear market plunge from March to May 2000, SDL Inc. shot ahead as a leading performer. The maker of components for fiber optic networks broke out to new highs just as the market confirmed a new uptrend, the most ideal situation for buying a stock. SDL Inc. ran up 112% in just 8 weeks. Among its many strong qualities was an SMR rating of A. For those of you who may not have always checked your stock's return on equity, it's important. Here's a table of past leaders that shows their ROEs. Accumulation distribution, the influence of professional trading on stocks. Professional investors wield a huge amount of influence over a stock's price. Thus, it's essential that you buy the better stocks that mutual funds are buying and that you sell or avoid the ones they may be selling on a heavy basis. Trying to go against this monumental amount of trading will only hurt your results. A quick, efficient way to keep track of the end result of professional trading is to use IBD's accumulation distribution rating, the column labeled 4 on the chart, which is based on daily price and volume changes. It tells you if your stock is under accumulation, professional buying, or distribution, professional selling. This thoroughly tested, complex, and proprietary formula is highly accurate and is not based on simple up-down volume calculations. Stocks are rated on an A to E scale, with each letter representing the following. A equals heavy accumulation, buying, by institutions B equals moderate accumulation. Buying by institutions C equals equal or neutral. Amount of buying and selling by institutions D equals moderate distribution selling. By institutions, E equals heavy distribution selling. By institutions, when a stock receives an or B rating in Investors Business Daily, it means that the stock is being bought on balance. However, this does not guarantee that it will go up. The buying activity is being picked up, but maybe the funds are buying into a questionable position, and what they are doing could be wrong. In some cases, stocks rated as D should be avoided. I would not buy a stock with an E rating. Later, however, if and when the market improves, it could change. Crated stocks may be okay. You needn't feel you've missed out on the trading action if you spot heavy buying or selling. Many funds take weeks or even months to complete their positions in a stock or rid themselves of those positions, which gives you time to capitalize on that action. However, be sure to check a daily or weekly stock chart to see if the stock is in the early beginning stage of a move or if it is overextended in price and too risky or late to more safely buy. Composite rating, an overview. The rating in the first column of the IBD stock tables is the SmartSelect composite rating, which combines all 4 SmartSelect ratings into a summary rating for quick review of overall performance. Look at the column labeled 5. The SmartSelect composite rating formula is simple. Because of the impact of earnings and previous price performance on stock price, double weighting is given to both the earnings per share and the relative price strength ratings. This weighting may change somewhat in the future as we continue to improve our ratings. Normal weight is given to the industry group relative strength, SMR, and accumulation distribution ratings. The percent off the stock's 52-week high is also used in the SmartSelect composite rating. The results are then compared to the entire database, and a 1 to 99 rating, with 99 being best, summarizes the 5 most predictive measurements we've just discussed. For some stocks, the SmartSelect composite rating may be higher than the 4 individual SmartSelect ratings. This is because the formula is weighted and includes the stock's percent off its 52-week high. When you review the stock tables, this simple rating gives you an enormous time-saving edge. Work your way down the columns and look for SmartSelect composite ratings of 80 or better to spot the potential strong opportunities when you are in an uptrending general market. The next step is to review all 4 individual SmartSelect ratings, EPS, RS, SMR, and accumulation distribution. With a quick scan of the stock tables, you're now that much closer to being sure you are selecting better stocks. Volume percent change tracks the big money flow. Another important measurement IBD created is volume percent change. See the column labeled 6. Most newspapers and information providers on TV and the web provide only a stock's trading volume for the day, which doesn't tell the entire, meaningful story. Based on the volume information they provide, how would you know whether the volume for all the stocks in your portfolio and those you're considering for purchase is normal, abnormally low, or abnormally high? In order to know this, you'd have to keep in your head or on paper what the average daily volume is for each stock under review. Instead, you can rely on IBD to keep track of this key measure of supply and demand for you. IBD was the first to provide investors with a volume percent change measure that monitors what the normal daily trading level for every stock has been over the most recent 50 trading days. It pays to always have the most relevant facts, not just a bunch of numbers. Stocks trade at many different volume levels, and any major change in volume can give you extremely significant clues. One stock may trade an average of 10,000 shares a day, while another trades 200,000 shares a day, and still another trades 5 million shares a day. The key is not how many shares were traded, but whether a particular day's volume activity is or is not unusually above or below average. For example, if a stock with an average trading volume of 10,000 shares suddenly trades 70,000 shares, while its price jumps 1 point, the stock has increased in price on a 600% increase in volume, generally a positive sign as long as other market and fundamental measurements are constructive. If this happens, the volume percent change column will show a plus 600%, which quickly alerts you to possible emerging professional interest in the stock. In this case, the stock is trading 600% above its normal volume, and if the price is up substantially all of a sudden, this can be a major tip-off. Volume percent change is like having a computer in your pocket to carefully monitor the changing supply and demand for every single stock. Where else can you get such preeminently critical data? Almost all daily newspapers have cut out essential information in their stock tables. This includes the Wall Street Journal, which no longer even shows a stock's trading volume in its daily stock tables. Volume percent change is one of the main reasons so many specialists on the floor of the New York Stock Exchange, professional portfolio managers, top-producing stockbrokers, and savvy individual investors use and refer to IBS stock tables. There is no better way to track the flow of money into and out of companies if you know how to utilize these data. If price is all you look at when you check your stocks, you're like a piano player who plays with only one hand, uses only one finger, has never heard of a chord or foot pedal, or doesn't read sheet music, so he never knows when to speed up, get loud, or get softer. Investor's Business Daily is more than a newspaper. It's also a gigantic radar set that monitors every variable that's important to the successful investor. And it lays all the information out for you daily, both in print and electronically, with the version that's available on the internet. The electronic version lets you have the information sooner, within hours after the market closes. Investors who like to prepare for the next trading day find this especially convenient. Others prefer a paper they can carry with them, make notes on, and use as a valuable guidebook. How to use Investor's Business Daily. Whether she uses the print or the electronic version, or both, each reader probably has a different way of reading the paper. My preference is to start with the front page and then proceed page by page to the end. Front page comes first. The first feature I check on the front page is the short, quick market summaries at the top, above the paper's nameplate. These show price and volume changes for the S&P 500 index, the Dow Jones Industrials, and the Nasdaq, plus brief, two-line comments on market highlights. Brief notes on fixed income, currency, and commodities are also shown. For example, the comment under NYSE volume reads, "Volume above average, up from previous day." In 40 seconds, I look at these briefs to make sure I didn't miss anything important from the day's action. IBS Top 10 Stories. The second thing I read on page 1 is IBS Top 10, a quick, time-saving way to stay informed. In briefs of only 7 to 9 lines each, the 10 most important news stories are summarized. Today, for example, the number 2 story tells how same-store sales were down last month at most retail chains, but Walmart's were not only up but better than expected. In the number 3 spot is Senate nears vote on stimulus, an update on Congress's efforts to come up with an economic recovery plan. The big picture. The third feature I always check on page A1 is the big picture column at the bottom. It's a fairly short but excellent summary of market action and key developments. Inside the column is Market Pulse, a valuable box that notes leaders that were up in volume for the day and those that were down. The pulse also lets you know whether the market's in an uptrend or a declining phase. The big picture column is one of IBS's most highly read features. Dedicated readers have repeatedly told us it has helped them immeasurably in dissecting the general market. In fact, more than 1,000 have given testimonials on how it has helped them raise cash when the market began getting difficult or determine when it was starting a major uptrend. Top stories. Finally, I glance at the headlines on the main 2 front page stories. I'm a headline reader. If a story is on a subject I want to know about, I read it. If not, I skip it and go to the next page. The top stories will often show charts or tables. The one I'm looking at has a table of 15 retailers. It shows sales changes for the month plus same-store results and estimates for the future. This quickly tells me 3 companies in the field are doing excellently, but many others aren't. To the point. Page 2 saves a busy executive or investor time. Titled To the Point, it provides some 50 business briefs, arranged by industry sector, and short summaries on the nation, the world, and the economy. I can quickly scan each headline and read the briefs I'm interested in. There's also a column called Trends and Innovations that I always try to read to learn about the new things that keep being invented in today's society. In the middle is a feature that's particularly valuable to the investor. A half dozen short stories about companies that reported earnings after the close and how the market reacted in after-hours trading. This is a fast way to make sure you didn't miss anything after the market close. Leaders and Success. Leaders and Success on page A3 is a unique feature that's been in the paper since we started. I always read Wisdom to Live By, the short 2- or 3-line quotes from famous people at the top of the page. Many people find inspiration on this page. It's about people who have been immensely successful, what they did and how they did it, what they believed in and how they overcame the problems they faced along the way. 10 Secrets to Success. Another element on the page is called IBD's 10 Secrets to Success. A lot of parents teach this to their kids by having them read these little short stories. The 10 secrets start with how you think is everything, always be positive, think success, not failure, beware of a negative environment. The second is decide upon your true dreams and goals, write down your specific goals and develop a plan to reach them. The third is take action. Goals are nothing without action. Don't be afraid to get started, just do it. The fourth is never stop learning, go back to school or read books. Get training and acquire skills. And so on until you get to the last one, which is be honest and dependable. Take responsibility, otherwise NOS. 1-9 won't matter. Below the list, one of the 10 secrets is discussed in detail each day. Parents find this is something their children don't get in school, and they use it to help them learn the basic principles of how to succeed in life. Rounding out the Leaders and Success page are 2 profiles of outstanding people, past and present, and how they succeeded. Internet and technology. The next page focuses on internet and technology. Some investors don't spend much time here, but if tech stocks are leading the market, you want to read this section to be on top of the discussions. We have a bureau in Silicon Valley staffed by experienced reporters who have been with us many years. The page they put together is designed not only for investors, but for anyone in the tech industry, computer programmers, engineers, systems people, and others. We have a subscriber who works at a big outfit the government uses to research how inventions might be applicable to defense efforts. One of the firm's top researchers has found that our writers get their facts straighter and understand the technologies better than those on most of the business magazines. We also have CEOs of computer software companies that subscribe to IBD, Your Weekly Review. There is a feature in the first section called Your Weekly Review. It includes a table of 35 stocks showing strong weekly gains and a chart on each one. It also includes a story on some of the companies. In a recent story, Paul Whitfield tells how the stocks of Netflix, Edwards Lifesciences, Matrix Initiative, and McDonald's are all acting in a superior way accompanied by interesting news. Inside Real Estate. The next page I turn to is Inside Real Estate. I don't normally read this, but somebody who is interested in the real estate market certainly should. The New America. Next is the New America page devoted to young, entrepreneurial companies. One company gets extensive treatment each day. At the top of the page, we sometimes have short briefs under the heading, After Market. The one I'm looking at is headlined, Neutral Tandem Soars on Q4 Results. It notes that telecom gear maker Neutral Tandem gapped up 11% in more than 7 times average volume, and then quotes what analysts are saying. When these tidbits of unusual activity catch my attention, I'll check them out on my computer and view a chart to see how the stock really looks. You never know how many ideas you're going to pick up from reading IBD. But in each issue, there will be several you'll want to check out. It takes no time at all to go to your PC, punch in the symbol that appears in the paper right alongside the first mention of the company's name, and check into the history of the stock, its earnings, and a few other key basics. Some of the best portfolio managers in the country quickly check out stocks this way to decide which companies they want to focus on or get more information about. It's a good way to add to your watch list. Mutual funds and ETFs. On the first page of the Mutual Funds and ETFs section, there are 2 information boxes I usually check. They zero in on growth funds with excellent records. The boxes show these funds' largest holdings in the latest quarter, along with their top new buys and sells. New buys may be of interest, We also show how the funds have performed relative to the market in each of the last 5 years. After you've taken the paper for a while, you'll know which are the better funds. One way you can judge is by noting their top positions. If the fund has 3 or 4 of the better leaders, I know the managers really know what they're doing. I don't normally look at our mutual fund tables, but I will frequently check 1 or 2 fund families that I know are outstanding to get a feel of how they're doing. We cover far more funds and include more data in our tables than most daily publications. Many papers have sharply cut the number of funds they follow. Besides current activity, we include the 4-week percentage change and a 36-month performance ranking for each fund. We also include the phone number for each fund family. A couple of tables in the fund section are unique. One shows how big cap growth funds are doing compared with small cap growth funds. The other compares growth funds to value funds. This is important for you to know in any market. Are growth stocks leading or are value stocks? Are big caps leading or are small caps? Here you have the answers at a glance. In the edition I have, growth is leading fund sectors. You also need to know the broad, overall sectors that are in demand. So on Fridays, we have 2 tables showing the top industry and sector funds. On other days, different fund types are displayed. If you're interested in what industries are doing well, you can see here that gold has been doing well in the last 4-week, 8-week, 12-week, and 16-week periods. The medical field shows well in the longer, 39-week table. Issues and insights. At the back of the first section, you'll find our editorial pages, titled Issues and Insights. We have an outstanding staff of a half-dozen highly experienced writers turning out up to 6 editorials a day. I do not write these. Wes Mann, our distinguished and talented editor, who has been with IBD from the beginning, is in charge of this key area and is assisted in the important role it plays for IBD readers and The Nation by Terry Jones, who has also been with IBD since its startup 25 years ago. Terry came to us from Business Week. I'll normally read 2 or 3 of the editorials after checking the headlines and summary paragraphs to see if I'm interested in the subject. We also have columns from guest writers plus syndicated columnists on the left and on the right, so you get different points of view. On the right, I always respect the work of Thomas Sowell and Victor Davis Hanson. Both are older, experienced observers with great insight. Sowell, from Stanford's Hoover Institute, is probably the best economist and historian in America. He has a new book just out entitled Applied Economics, Thinking Beyond Stage 1, one of 42 books he has written. From Washington, we run columns by conservative Charles Krauthammer and liberal David Ignatius, who is well informed on international issues. But the first thing I look at each day in Issues and Insights is the cartoon. We have the best editorial cartoonist in The Nation, Michael Ramirez. He won a Pulitzer Prize for Investors Business Daily in 2008, the second time he had received this prestigious award. IBD also has an extensive public polling operation, conducting monthly surveys on economic confidence, presidential leadership, and major national issues year-round, and daily tracking polls in election years. In 2008, for the second presidential election in a row, the IBD tip poll not only came closest to the final margin between Barack Obama and John McCain, but was right on the money. These feats, tantamount to hitting a bullet with a bullet, have earned the IBD tip poll, conducted by Technometrica Market Intelligence, the honor of being America's most accurate. Making money. In the Making Money section, starting on page B1, we try to cover the relevant facts, skills, and rules you need if you are to be a successful investor. We view Investors Business Daily as an educational medium. We don't tell people what to buy. We don't recommend stocks or tout 10 stocks that are going to go up tomorrow. We just explain time-tested rules based on models of successful stocks in all of past history and provide sound techniques and methods for managing your portfolio wisely. We also give classes and several levels of paid workshops, from beginning to very advanced, on investing. In addition, we have a chart school, have several books out, including this 4th edition of the one you're reading, and offer a home study course. We view our mission as being to teach anyone who wants to learn how to become a better investor and protect himself so he doesn't get hurt in bear markets. NYSE plus NASDAQ stocks on the move. The first thing I read on page B1 is the NYSE plus Nasdaq stocks on the move tables, a feature that's in no other publication. We have a massive computer database that each day screens for those stocks that had the greatest increase in trading volume over and above their average daily volume in the last 3 months. This isolates the true demand for securities you would not otherwise notice. On these lists, you'll find many new, innovative companies with names you may not know. But if they appear frequently, you'd better find out what they're doing or making. They could be the next Microsoft or Apple. In this current issue, Visa is on the NYSE list. It was up 4.6 points on a volume increase to 239% more than normal for the credit card company. Visa just reported earnings during a bearish period. There were also a few medical stocks on the lists. In addition to price and volume change, the tables show the same company variables IBD shows in its main stock tables. For example, IBD shows the earnings per share rank of Visa as 99, meaning its earnings growth rate in the last 3 years, and in recent quarters puts it in the top 1% of all companies in our database. This doesn't mean the stock's going to go up, but it certainly means it has characteristics worth checking if you're hunting for entrepreneurial stocks that might outperform in a future better market. We boldface those names on this list that have earnings per share and relative strength ratings of 80 or higher, meaning they're in the top 20% of all stocks based on those measurements. The stocks with stronger records are the ones you want to investigate. Below the list of stocks that advanced for the day is a list of stocks that were down in price. They too are ranked by percentage increase in volume. You can judge the market environment and how well our new government is doing by how many stocks are on the upside versus how many are on the downside. In the example shown, the table has 8 NYSE stocks on the upside versus 36 on the downside, meaning there were more stocks that day with greater than normal volume that dropped in price than that increased in price. This zeroes in on the daily supply and demand for leading securities. It was a bearish day. I found this computer screen to be valuable. For it to fail to pick up a new big leader is almost impossible, but you've got to do your own homework to understand some of these names you might not know. IBD also tries to cover these companies in our various columns. How's the market? Page B2 is titled How's the Market? It is loaded with absolutely crucial data. We present the 4 key general market indexes, the NYSE Composite, Nasdaq, S&P 500, and Dow Jones Industrials in large, easy-to-read charts. We stack them one on top of the other so you can compare them and see which indexes are stronger and if one index diverges from the others at some point. At this time, we note that while all the indexes were in a negative trend in January, the Nasdaq was down only 2%, less than the others, implying it is the leader at this stage in a difficult market. We also have relative strength lines, moving average lines, and a line just below the NYSE Composite chart that displays the New York Stock Exchange Advanced Decline line, which lets you quickly see day by day over the last 6 months if more stocks on the NYSE were advancing or declining. There's even an accumulation distribution measure showing which of the major indexes has the largest amount of accumulation. At this reading, the Nasdaq had a B, meaning it has recently enjoyed stronger accumulation than the others. B2 is a page I look at every day, and you should too. I want to carefully check the recent price and critical volume activity of the leading indexes on a day-by-day basis to see if they're still in an uptrend and under accumulation, or if they're shifting into a new downtrend and behaving in a highly negative way. Don't neglect the daily volume. It's the key that can tell if something is going wrong. If you study and learn to interpret the general market indexes correctly, which can take some time, you will learn how to avoid most of the serious declines, because the increased distribution always shows up in the early stages, before the more damaging part of a decline evolves. This can preserve a good bit more of your money and is something it's definitely worth striving to perfect, no matter how much time it may take you. How much time, after all, did you spend earning the money you now hope to invest? So is it worth your time to learn how to skillfully preserve and protect it? If you learn to read the market and apply IBD's general market rules, there's no excuse for finding that you are down 30%, 40%, or 50% or more in any bear market. I know most public investors and maybe some readers of the paper were possibly hurt in the market correction of 2008. But IBD supplied the rules and information. If readers did their homework and read the big picture column, they should have seen that IBD's method picked up the adverse activity in the earlier stages of the emerging bear market decline that developed in late 2000 and 2008. You can and must learn to spot the following. October 3, 2007 was the first distribution day on the Nasdaq, October 11 was the second, October 15 and 16 were the third and fourth, and October 19 was the fifth. If you saw and read this correctly, you would have sold something. On October 24, you had a sixth distribution day, and you should have cut back further. By November 1, you had 7 crucial warnings. This is how all important market corrections and bear markets begin. If you missed this and were totally unaware of what was happening, go back and study all the market top charts in Chapter 9 until they make sense to you and you understand what you must look for in the future. Many investors have discovered they need to take charge, get serious, and learn the basics of sound, successful investing. You can do far better in the future. IBD Mutual Fund Index. There is another unique feature on page B2 you can't find in other daily publications, the IBD Mutual Fund Index, where we pick 24 leading growth funds and show their composite performance in a graphic display. I use this as a supplementary index because it is in a way a giant advanced decline line of some of the better funds, with a combined 1,000 to 2,000 or more stocks owned among the 24 funds. When I've seen a classic, well-formed cup with handle pattern in this index, preceded by a strong prior uptrend to the pattern, the index and the market have almost always moved up. IBD's 197 industry subgroup rankings. On this jam-packed page, we also have IBD's 197 industry subgroup rankings. This list shows a composite rating for each subgroup, and each subgroup's change from the previous day, plus where the group ranked 3 and 6 weeks and 7 months ago. The top 20 and bottom 20 subgroups are circled because they represent the best and worst performing industries. By now, you should know I am not going to own anything in the bottom 20 because we've proven over many years that these industries are going to be having a lot of trouble. On the other hand, we know that most of the leading areas of a positive market will show up in the top 20. The reason we have 197 subgroups is that within every sector, there are segments that can perform quite differently. Medical genetics is our third ranking group. 7 months ago, it was 57th. All told, we have 10 tables that measure industries from different points of view. 2 small boxes on page B2 that I also check each day give you another perspective on which industries are leading. One shows the top 10 Fidelity industry funds since Jan. 1. The second small box shows the groups with the highest percentage of stocks at new highs. With several different ways to look at market sectors, you can hardly miss the 1 or 2 sectors that turn out to be the real leaders in each new bull market. Next to those boxes, there's a list displaying indexes of 28 different market sectors and how each performed for the day. IBD Industry Themes. On page B3, we have another way of keeping track of industries, a daily column called IBD Industry Themes. In every market, there are certain leading themes. Investors may be buying medical stocks, for example, or technology stocks. So what are the themes in the current market? We also have a column on New York and Nasdaq stocks, and one for the long-term investor. Another 3 columns on page B5 include the base reader, which analyzes various chart patterns, the income investor, and international leaders, covering the foreign markets. I don't read all these columns, but I do read the headlines, and if a quick glance tells me a column is talking about some situation I'm interested in, I'll read it. 2,500 leading stocks, NYSE plus Nasdaq research tables. A powerhouse element we've added recently is the way we organize and display our one-of-a-kind stock tables. We call them research tables because we have a boatload of data on each company. IBD follows up to 2,500 stocks, combining New York and Nasdaq stocks in one table, whereas some of our competitors carry only 1,000 stocks, and have nothing close to the critical ratings and data we provide for each company. Right off the bat, you'll see that our 2,500 leading stocks tables starting on page B3 are organized in order of the strongest of 33 broad economic sectors. Almost everyone else's tables are organized alphabetically. For decades, Americans used the stock tables in their local newspaper or in one of our financial competitors just to look up where their stocks closed yesterday. Was my General Motors up, or was it down? While it's nice to be able to check how your stock did, these days you can get quotes anywhere on the web. What we're doing is making the tables an advanced research lab to help you discover the next big leading stock you'll want to invest in. Here's what we're able to do with how we display the tables. This particular issue confirms what we saw in other tables, that the medical sector is number one. Then we show every one of the stocks in the medical field, listed alphabetically. Each has a composite rating, which goes from 0 to 99, with 99 being the very best. This is an overall rating that considers key individual ratings. Of course, this current rating could decline if our government succeeds in its attempt to rewrite all the rules and decide how it wants to run our entire medical system. If you spot a stock that looks interesting, we have given you the stock symbol, and you can go to Investors.com and check out the chart or other vital facts and figures, using a handy checklist to flesh out what you've uncovered in the tables. As I scan the tables, I look for stocks that are bold-faced. Here, too, we bold-face anything that's up 1 point or more or is making a new high in price. I'm mainly interested in keeping track of price movements, so I don't miss anything that might turn out to be a huge new leader. The bold-faced stocks can be scanned very quickly, and if you're using charts, you may already be aware of the patterns of some of the ideas you notice in the tables. For example, if you go through a number of charts every week, looking for sound patterns with strong fundamentals, and you scan the bold-faced stocks in the tables daily, you'll see a bolded stock whose chart you were impressed with start to move up. When I spot unusual activity by high-ranked stocks, I tend to write down the symbol at the top of the B1 page. When I get through scanning the tables, I may have 8 or 10 symbols that I'll check out because they look interesting based on their price activity and high ratings. You can go right to Investors.com or Daily Graphs online and evaluate the chart to see if the stock is acting right or acting poorly. So rather than using the tables just to find out how my stocks did yesterday, I'm using them to screen for potential ideas that might become super leaders at some point in the future. For any serious investor, this is almost a necessity if you are going to improve your performance. You can do it too. At the top of page B4, we have something called You Can Do It Too. These are short quotes by investors who have written to tell us they've done well and what their main observations were. I realize there are a number of people who probably aren't so successful or who haven't done their homework, didn't follow rules, or didn't have any system. Many of these quotes, however, are inspiring. It's interesting that more than 1,000 people have written to tell us that they've finally figured out how to put it all together to achieve outstanding results. I say finally, because it takes some time and effort to get truly superior results. There are no free lunches in the stock market, but once you understand and apply yourself, you could in time become financially independent. Would that be a worthy goal for you to strive for and achieve? Stocks in the news. A section that I also check every day is what I call the mini charts in the NYSE Stocks in the News and NASDAQ Stocks in the News sections. We used to show 20 or more charts in this screen, but we've now limited it to 10 because we've refined and improved the sorting mechanism. And what we've learned is that once you're in any future bull market, these two lists will materially outperform the S&P 500, and any new names on the charts will be well worth your checking. If you're in a bear market, don't expect these lists to work. 3 out of every 4 stocks will be going down in such an environment, and growth situations can have significant corrections. But if you know you're in an uptrending market, and this is confirmed by the big picture column, these mini charts, each of which is packed with 20 key statistics, can be a source of high probability new ideas. They won't all work, but when you're in a positive market, you follow up on the ideas that work. Sooner or later, if you're patient, a market will develop into a strong bull market. And when that happens, these are definitely screens you want to check out thoroughly. If you do your homework, you then have a better chance of materially improving your performance. Over time, I've found that the first 6 or 7 sectors in our stock tables will contain most of the new leaders. I've also found that just because some of the sectors in the back half haven't been leaders recently doesn't mean that some of them won't later possibly become turnarounds. Lower ranked and poor performing sectors in this issue are computer, hardware, savings and loans, apparel, machinery, media, steel, real estate, and semiconductors. These rankings can shift over a period of weeks or months, but it pays to know what's leading now and which names within each sector have the best fundamental and market action variables. That's where you want to concentrate your research. These tables may take a little time to get used to, but after a few weeks, you'll know where your stocks are listed. To make it easier, we also have a table that lists all of IBD's 197 sub-industries and tells you which of the 33 broad sectors each sub-industry belongs to. One thing that most of us fail to do, but that I would highly encourage you to do, is read the box, usually on page B7, that explains the various ratings and measures and how they're computed and used. By doing this, you will understand how best to utilize these advanced, very sophisticated tables that could hold the key to dramatic success or improvement in your future. Below the How to Read box is a short list of do's and don'ts. In other words, what you should be doing to avoid the classic errors people sometimes make when they're investing without doing their due diligence. IBD Time Saver Table. The IBD Time Saver Table on the same page is a feature many busy people like to use because it picks up all the high-ranking stocks that were up or down in price in a short table that includes volume and some other rankings. I always check this and take particular note of the stocks down list. I want to be aware of the stocks that have been hit hard because this could affect others in the same industry. If a stock shows up repeatedly on this list, it could be that it has topped and is headed for more trouble. I've mentioned that we have 10 different ways you can zero in on the leading groups. We also have little sector charts under the heading Leading Market Indexes. Each has a daily price and volume chart. High tech, junior growth, leisure, and consumer sectors now top the list. Alongside, we have the new highs list. This list has also been reorganized. We weren't interested in just showing which stocks made new highs and which made new lows. We list them in order of the industry sectors that had the largest number of stocks making new price highs. When you get into a strong bull market and find that, say, the medical sector continues to lead, it will probably be among the top 1, 2, or 3 sectors with the most stocks making new highs. When high technology was leading in the bull market of the 1990s, the computer sector was number 1 for a year and a half. Stocks like Cisco and Dell were constantly on the new high list. If you knew what you were looking for, and you understood the significance of a stock's displaying new highs in a bull market, maybe you too could have participated when these stocks were going up 10 times or more. There's a lot you can learn by studying past markets. We are historians. In other words, it's hard not to notice the real action and the real leaders in the market. They are as obvious as the elephant that jumps into the bathtub and splatters water all over the place. When a whole sector is moving, the sheer volume and broad-based activity cannot be hidden. We saw this in the energy sector from 2004 to 2007, when virtually all oil and gas stocks were moving up dramatically. At some point, all sectors change, and when they do, the 10 different ways we have to pick up leaders and laggards will point you in a direction where you can say, those stocks are no longer leading the way they did before. If you just go on emotions and your attachment to a stock, you can get into a lot of trouble. You need precise measurements to tell you if this sector or that security is really behaving properly. One last thing, earnings are what drive a stock, and the rate of earnings improvement is more important than the P/E ratio. So you want to make sure you check the company earnings reports that come out at certain times during a quarter. You can discover a company that's suddenly showing much better earnings than in the past. It helps to be up on stocks that come through with better than expected earnings, what the street refers to as earnings surprises. What we have learned to watch for are stocks whose earnings estimates are constantly being raised and that show an acceleration in their percentage rate of increase in earnings quarter by quarter. As I mentioned earlier, the bigger the earnings increase, the better. And we don't fall into the trap of eliminating any stock just because its P/E ratio looks high. To wrap up the paper, we cover more futures and options than most publications. There's a column on the bond market, several interest rate charts and tables, and no fewer than 36 charts on commodities futures. Key commodity futures, Investors Corner and IBD 100. Among other IBD features, Investors Corner is a popular daily educational column for anyone who wants to learn more about investing. And every Monday, we show the IBD 100 with charts on 100 high-ranked potential prospects. How to use Investors.com. Investors.com is the online companion to Investors Business Daily's print edition. Like the newspaper, it helps you quickly and confidently apply the investing strategy outlined in this book. Whether you have just a few minutes each day or you're investing full-time, you can develop an effective routine that fits your schedule using the tools and features found on Investors.com. We discuss the ways Investors Business Daily starts the research process with an efficient assessment of the market, industry groups, and stocks. Here are some additional ways to dig deeper in your research with IBD's specially designed screening tools and charts. If you're reading this book to hone your investing skills, going through these tools in the following manner will help you develop an easy daily system for reviewing the market, top industries, and finally, the top stocks. The IBD stock research tool on the home page of Investors.com is structured to let you do just that from one central location. As you can see from the graphic on this tool, you can use it to follow market direction and to find, evaluate, and track leading stocks. Following this approach will help you find the best stocks, will let you know the right time to buy and sell, and could materially improve your results. The key is to take some time to become familiar with the investing tools and features on Investors.com. The slim chapters in this book will help you understand the rationale for IBD's investing tools, which are programmed to search for companies with the performance characteristics typical of emerging stock market winners. Market direction. As discussed, 3 out of 4 stocks usually follow the overall market trend, whether it's up or down. That's why it's critical for you to learn to follow, not fight, the market. Within the Market Direction tab, you'll find links to features that will help you do just that. Start by taking another look at the big picture and market pulse to see what stage the market is currently in. You can also click on the indexes link to view the latest charts for each of the major indexes. The charts are updated throughout the trading day with a 20-minute delay. For timely analysis of the market action as it happens, read the Markets Update, featuring 9 intraday reports. You'll find concise insights that put the day's events into perspective, plus highlights of leading stocks making a big move. IBD TV, Market Wrap. Regularly watching the IBD Market Wrap video is another good way to stay on top of the market and improve your analytical skills at the same time. Available by 6:30 p.m. ESD, each trading day, this short video uses charts to visually show you how the market and leading stocks are acting and what trends and potential buy points to look out for. Find stocks. Once you've reviewed the current market conditions, use the Find Stocks tab to look for new investing ideas. Here you'll find a wide range of idea-generating screens in addition to those in the IBD print edition. Stocks on the Move trademark. Learn what the institutions may be buying and selling as it happens. This is the online version of the IBD print edition feature. As we've mentioned earlier, just looking at typical most active lists won't give you the whole picture. You need to know about the emerging institutional trades that are beginning to show promise. These stocks will appear on this radar screen, which is updated continuously throughout the trading day. You can quickly spot the stocks that institutions may be moving into or out of in a major way as it happens. Remember that institutional buyers who are taking a position in a stock usually buy in huge quantities, which may create major volume in the stock. Nearly every winning stock will show this type of activity at the onset of its price advance. You don't want to miss this screen if you are searching for emerging leaders. Remember that not all the stocks shown on this list will be winners. It's important to check further to make sure the stock's chart looks sound and the ratings show leadership potential. This is a good way to spot the breakout of a stock as it is happening or shortly thereafter. Intraday volume percent change. Another way to spot possible winners, a key element of the online version of Stocks on the Move, is the intraday volume percent change. As we've seen, a stock needs support from institutional buying to propel it further. Volume percentage changes on an intraday basis will tell you, as it is happening, if a stock is trading above or below its average daily volume of the last 50 trading days. That's a sign of institutional buying or selling and a key component of Stocks on the Move. You can also get the intraday volume percent change for any stock you're looking at on the Stock Quotes page of Investors.com. Screen Center, click on the Screen Center link to pull up the latest screen of the day. Each day, there's a different list that sorts the entire stock database looking for potentially superior stocks based on important performance criteria. This is a quick way to find leaders and the better possible ideas in different categories. The rotating screens include categories such as Top Relative Price Strength Stocks, SmartSelect All Stars, and Top Acceleration in Earnings. To access additional stock lists, click on Screen Center in the drop-down menu within the Stock Research tab on the Investors.com homepage. You'll find more possible investing ideas from lists including Slim Select, Sector Leaders, Tech Leaders, and Long-Term Investor. Most active, NYSE and NASDAQ. This daily column, also found in the print edition, highlights breakouts and basing patterns in the best institutional quality stocks experiencing unusually heavy trading volume. You'll also find a discussion of potential buy points that indicate the best time to make initial and secondary purchases. This column will also flag potentially negative action as stocks reach their peaks. Evaluate stocks. Next, let's look at how you can evaluate any stocks you already own or are thinking of buying. There are many questions that should first be answered. Is this the right stock to own, or are there better ones in its group? Is the stock in a leading industry group or a laggard one? If you own the stock, have you held it too long? If the stock looks fundamentally strong and you want to invest in it, is it too soon or too late? Are we in a bull market or a bear market? These are just a few questions that need to be answered before you make your move. 2 IBD investing tools, IBD Stock Checkup and IBD Charts, will help you sort through the stock picking puzzle. IBD Stock Checkup. IBD Stock Checkup evaluates and compares more than 6,000 publicly traded companies and assigns a composite rating and a pass, neutral, or fail grade to put your ideas in the proper perspective. It's essentially a statistical summary report made up of several components, including composite rating, performance within group leaders, IBD stock checklist, with a pass, neutral, or fail grade. Red light, green light. For the composite rating and most of the components listed in IBD Stock Checkup, you'll see a green pass, yellow neutral, or red fail icon. This is a quick and easy way to see if your stock passes muster in that particular category based on time-tested slim criteria. Composite rating. As we discussed earlier, the composite rating is a quick way to know whether you should move ahead or not. With the color-coded icons within the IBD stock checklist, see point in the chart. It's like a traffic light that tells you whether to go green, slow down yellow, or stop red in your research, and it will guide you toward only the very best companies. Performance within group. Buy the best stocks in the top groups in the Performance Within Group section. You can see how the stock specifically performs against the rest of the stocks in its industry group. The rankings are based on IBD SmartSelect ratings. This will help you determine if you're making the right choices. It's easy to be swayed by news or TV tips, but this should give you a major edge by forcing you to stick to the facts. Group leaders, pointing you toward real potential leadership no matter what you've bought or are thinking about buying. This screen shows you where the real leadership is. These are the stocks exhibiting the type of performance that might propel them further in an uptrending general market. You can click on each of the SmartSelect ratings to see which stocks in the group rank highest for that individual rating. IBD Stock Checklist is your stock rated pass, neutral, or fail. The IBD stock checklist gives you a thorough review of the fundamental and technical strength of each stock, along with a pass, neutral, or fail grade for each category. For example, at the very top of the stock checklist, you'll see a green, yellow, or red icon next to the composite rating. This will help steer you toward the true market leaders and away from the laggards. In the general market and industry group section, you'll also get a pass, neutral, or fail grade for the general market and for the relevant industry group. Do not buy stocks when the general market flashes a red signal. IBD charts show you the right time to buy or sell. You never want to buy any highly rated stock in IBD's tables without first checking a chart, and it pays to regularly review both daily and weekly charts on any stocks you own. This is a vital step that will help you spot emerging trends and track a stock's movement so you know the exact time to buy or sell. IBD charts are designed to make it easier and faster for both new and experienced chart readers to get the real picture. These daily and weekly charts are free when you register on Investors.com. For those who are intimidated by charts, think of a stock chart as a picture worth 1,000 words. It will tell you some vital things about the progress or lack of progress of any company. In time, you will find your review is quite automatic. Daily charts can also help you spot possible future winners. IBD daily charts include the following: up days in price in blue, down days in red, continually updated price and volume data, EPS and RS ratings, relative price strength line, 50 and 200-day moving averages of price. Refer again to Chapter 2 to learn to recognize chart patterns. You may also want to consult the IBD University section of Investors.com for a course on chart analysis. Also remember that the majority of stocks tend to follow the overall trend of the market, so be sure to check current market conditions, as discussed earlier, to confirm that your overall timing is correct. Weekly charts. Tip-off to institutional trading. IBD weekly charts will help you gauge institutional buying. Since mutual funds typically take days, if not weeks, and sometimes longer, to build or unload their positions, any heavy volume on the chart may tell you if they're possibly moving into or out of a stock in a major way. Weekly charts include the same information that appears on the daily charts, with the addition of shares outstanding. These charts span nearly 2 years of price and volume movements. To capture the biggest gains, it's important that you use both daily and weekly charts, since they offer different views on a stock. You will get more exact timing indications from the dailies and the big picture from the weeklies. Track stocks. Once you've evaluated and purchased a stock, it's crucial that you track its performance. Buy and hold is a dangerous strategy, as all stocks, even those of well-known established companies, can be volatile and risky. To be a successful investor over the long haul, you need to keep all your losses small and to know when to sell and take your profits. Chapters 10 and 11 discuss how you can do that with time-tested sell rules. The My Stock Lists feature on Investors.com will help you stay organized so you can apply them effectively. My Stock Lists. With My Stock Lists, you can create up to 5 lists with up to 50 stocks on each list. To stay organized and save time, you can create different lists for different purposes. For example, you could create a My Portfolio list for the stocks you own, a list of stocks in bases for leading stocks that are currently forming a base, and a near a buy point list for stocks that are approaching a proper buy point. It's important that you review and manage your lists regularly, adding and deleting stocks as needed. To help you track the performance of your stocks, the My Biggest Price Movers feature automatically alerts you to the stocks on your lists that are making the biggest price moves, up or down. My Stock Lists also gives you one-click access to IBD Stock Checkup, IBD charts, and IBD archives for each stock. Use IBD archives to read what IBD has written about the companies you're watching. It can provide valuable insight into the story behind the stock. Use IBD Stock Checkup and IBD charts to continually evaluate both the stocks you own and those you're watching. My Routine. Create your own custom investing routine. My Routine gives you one-click access to your favorite tools and features from virtually any page on Investors.com. It's a convenient, time-saving way to go through your investing to-do list quickly. Here's a sample routine you could set up to follow market direction and find, evaluate, and track your stocks. 1. The big picture. 2. Screen center. 3. IBD stock checkup. 4. IBD charts. 5. My stock lists. Continuing education, the key to investing success. IBD University, for most investors, not a day goes by without questions. The IBD University section of Investors.com provides a complete stock investment course to help you improve your knowledge and skill. It outlines every aspect of buying and selling stocks, along with chart reading and many other important topics. The lessons are free, and you can take them at your own pace anywhere you have an internet connection. IBD TV, Daily Stock Analysis. The Daily Stock Analysis video reviews the technical and fundamental strength of a current leading stock. Watching this every day will give you new investing ideas and help you improve your own chart reading and analytical skills. You can also read the Daily Stock Analysis column for a summary of key points discussed in the video. Investors Corner. Find answers to your questions. You can search the archives of the Investors Corner column to quickly find detailed answers to beginning, intermediate, and advanced questions on a wide range of investing topics. IB Dextra monthly newsletter. The IB Dextra newsletter provides exclusive videos, articles, and stock lists to help you follow current market conditions, improve your investing skills, and get the most out of IBD's features and tools. The newsletter is free when you register on Investors.com. IBD TV. Watch your results improve. IBD TV offers a unique way to reinforce and master the strategies outlined in this book. The IBD Market Wrap and Daily Stock Analysis videos show you, on a daily basis, how to apply ConSlim in the current market conditions. We also produce special video and audio analysis as needed to help you navigate major market events, such as the financial crisis in 2008. The key is to tune in regularly. Make IBD TV a part of your routine, and you'll see your investing skills and confidence improve significantly. For the latest videos, visit www.investors.com IBD TV. Tap into the IBD community. Since we started publication in 1984, IBD has helped countless people achieve financial success. It has created a vibrant community of investors who proactively share their ideas and knowledge, both online and offline. Here are 2 ways you can get involved in and benefit from the IBD community. IBD Meetups. The IBD Meetup program gives you the chance to meet face-to-face with fellow IBD investors in your city. It's an excellent opportunity to share ideas and experiences with like-minded investors who follow the ConSlim system. There are over 400 groups worldwide, and membership is free. To find the IBD Meetup in your area, visit http://ibdmeetup.com. IBD Forums. IBD Forums is the official online message board for IBD and ConSlim investors. On IBD Forums, you can post, read, and reply to messages on a wide variety of investing and other related topics. You can register for free on Investors.com. Chapter 17, Watching the Market and Reacting to News. Tape reading is emotional. Ticker tape watching or being glued to your PC or watching the market on a TV channel all day can get dangerously emotional. Sometimes a stock keeps rising to the point where everyone, including you, is convinced it's going straight through the roof. That's when discipline is most needed because the stock is probably topping. When a stock's merits are so obvious that it looks fantastic to everyone, you can be sure almost everyone who can buy it has already done so. Remember, majority opinion is rarely right in the stock market. Winners in the stock market need perspective, discipline, and self-control above all else. Those who continually sit in front of the moving ticker tape that shows many stocks as they change prices or their PC monitoring hundreds of stocks changing prices risk making emotional decisions. Is the stock in a base or is it too extended? There's an easy way to keep your head if you're keeping your eye on the tape or on your PC. You see activity that impresses you, always refer to a weekly chart to see if the stock is building a base or if it is extended too far past its buy or pivot point. If it is extended, leave it alone, it's too late. Chasing stocks like crime doesn't pay. If the stock is building a base, then apply the ConSlim system. Are current earnings up a meaningful amount? Is the 3-year earnings record good? Have you checked all the other ConSlim criteria? More than half the stocks that look inviting on the tape will fail the ConSlim test and prove to be deficient, mediocre investments. However, sooner or later, convincing market action will point you to a golden opportunity that meets all your criteria for a possible star performer. Scan chart books weekly and list buy points. Another way to use the tape or market action productively is to review a comprehensive chart book every week and make a list of stocks that meet your technical and fundamental selection criteria. Then jot down the buy point at which you would consider buying each stock. Also note the average daily volume for each stock on your prospect list so that you can easily verify any noteworthy increases in volume. Keep this shopping list with you every day for the next couple of weeks as you watch the market. In time, one or two of the stocks on your list will begin to approach your buy point. This is the time to get ready to buy. When the stock trades at your buy point, you anticipate the day's volume will be at least 50% above average, and the general market direction is positive. More demand there is for a stock at the buy point, the better. Tape and market watchers expect the pace of activity to slow down around lunchtime in New York, 12 p.m. to 1 p.m. Eastern. They also know the market frequently shows its true colors in the last hour of the day, either coming on and closing strong, or suddenly weakening and failing to hold the gains established earlier in the session. Don't buy on tips and rumors. I never buy stocks on tips, rumors, or inside information. Doing so simply isn't sound. Of course, tips, rumors, and inside information are what most people are looking for. However, I should remind you again that what most people believe and do in the market doesn't work very well. Beware of falling into the typical market traps. Certain advisory services and columns in some business newspapers are fed by street gossip, rumors, and tips, along with planted personal opinions or inside information. These services and columns, in my opinion, are unprofessional and unsophisticated. There are far sounder and safer methods of gathering information. Bernard Baruch stressed the importance of separating the facts of a situation from tips, inside dope, and wishful thinking. One of his rules was to beware of barbers, beauticians, waiters, or anyone else bearing such gifts. Watch for distortion around the end of the year and in early January. A certain amount of distortion can occur in optionable stocks around option expiration dates. There's also a significant amount of year-end distortion in stocks during December, and sometimes through January and early February. Year-end is a tricky time for anyone to buy stock, since numerous trades are based on tax considerations. Many low-grade losers will suddenly seem strong, while former leaders lie idle or start to correct. In time, this misleading activity dissipates, and the true leaders re-emerge. General market sell-offs also occasionally start after the beginning of a new year, which further adds to the difficulty. Fake-out action can occur with one big up day followed by a big down day, only to be followed by another big up day. There are times when I'd rather take a vacation in January. January effect, where small and mid-cap stocks get a boost during January, can be a misleading and spurious indicator. At best, it works for only a brief period. It's important that you stick with your rules and don't get sidetracked by questionable, less reliable indicators, of which there are many. Interpret and react to major news. When domestic or foreign news of consequence hits the street, capable market sleuths are sometimes less concerned with whether the news is good or bad than they are with analyzing its effect on the market. For example, if the news appears to be bad but the market yawns, you can feel more positive. The tape is telling you that the underlying market may be stronger than many people believe. On the other hand, if highly positive news hits the market and stocks give ground slightly, the tape analyst might conclude the underpinnings of the market are weaker than previously believed. Sometimes the market overreacts to, or even counteracts favorable or disappointing news. On Wednesday, November 9, 1983, someone ran a full-page ad in the Wall Street Journal predicting rampant inflation and another 1929-type depression. The ad appeared during the middle of an intermediate correction in the market, but its warnings were so overblown that the market immediately rebounded and rallied for several days. There's also a difference between a market that retreats in the face of news that's scary but easy to understand and explain, and one that slumps noticeably on no apparent news at all. Experienced market investigators have long memories. They keep records of past major news events and how the market reacted. List would include President Eisenhower's heart attack, the Cuban Missile Crisis, the Kennedy assassination, an outbreak of war, the Arab oil embargo, expectations of government actions such as wage and price controls, 9/11, war in the Mideast, and more recently, in early September 2008, when subprime real estate news got worse and the market expected a very liberal president to be elected. Old news versus new news. After it's been repeated several times, both good news and bad news become old news. Old news will often have the opposite effect on the stock market from what it had when the news first broke. This, of course, is the opposite of how propaganda and disinformation work in totalitarian dictator-controlled countries. There, the more often a lie or distortion is repeated to the masses, the more it may become accepted as truth. Here, when news becomes widely known or anticipated, it's discounted by experienced individuals in the marketplace, blunting the effect of its release, unless, of course, the news keeps getting worse than expected. To market neophytes, news can be paradoxical and confusing. For example, when a company releases a bad quarterly earnings report, its stock may go up in price when this is reported. When this occurs, it's often because the news was known or anticipated ahead of time, and a few professionals may decide to buy or to cover short sales once all the bad news is finally out. Buy on bad news is what some wily institutions use as a guide. Others believe they should step in and provide support for their large positions at difficult times. Analyzing our national news media. How the national news is edited and presented or suppressed dramatically affects the economy and public confidence. It can also influence public opinion of the government, elections, our presidents, and our stock market. Several excellent books have been written on the subject of analyzing our national news. Humphrey Neal, author of the 1931 classic Tape Reading and Market Tactics, also wrote The Art of Contrary Opinion. Carefully examines the way identical news stories are reported quite differently in the headlines of different newspapers, and how that can be misleading to stock owners and the public. Neal developed contrarian theories based on how frequently conventional wisdom or consensus opinion expressed in the national media turns out to be ill-conceived or just plain wrong. 1976, media expert Bruce Hirschensohn wrote The Gods of Antenna, which tells how some TV networks manipulate the news to influence public opinion. Another book on the subject is The Coming Battle for the Media, written in 1988 by William Rusher. One of the most outstanding studies on the subject is The Media Elite, written by Stanley Rothman and Robert Lichter in 1986. Rothman and Lichter interviewed 240 journalists and top staffers at 3 major newspapers, the New York Times, the Wall Street Journal, and the Washington Post, 3 news magazines, Time, Newsweek, and U.S. News and World Report, and the news departments of 4 TV networks, ABC, CBS, NBC, and PBS. On average, 85% of these top national journalists were found to be liberal, and to have voted the Democratic ticket in national elections in 1964, 1968, 1972, and 1976. Another survey showed only 6% of national journalists to have voted Republican. A Freedom Forum poll reinforced the media elite when it documented that 89%, 9 out of 10, of Washington reporters and bureau chiefs voted for Clinton in 1992, and 7% voted for the first George Bush. More recently, Tim Grosclose of UCLA and Stanford and Jeff Milio of the University of Chicago published A Measure of Media Bias. They counted the number of times a news outlet quoted certain think tanks and compared this with the number of times members of Congress cited the same think tanks when speaking from the floor. Comparing the citation patterns enabled them to construct an ADA Americans for Democratic Action score for each media outlet. They found that Fox News' special report was the only right-of-center news outlet in their sample. The most liberal was CBS Evening News, followed by the New York Times, the Los Angeles Times, USA Today, NBC Nightly News, and ABC's World News Tonight. More surprising was the astonishing degree to which the mainstream media in these surveys are much more liberal than the general voting public. In the 1984 presidential election, Mondale vs. Reagan, the ABC, CBS, and NBC prime-time news programs from Labor Day to Election Day were taped and dissected by Maura Clancy and Michael Robinson. They focused only on reports in which spin for or against each candidate was definite. Public Opinion magazine found Reagan got 72 seconds of bad press and only 730 of good, while Mondale enjoyed 13 seconds of good press and 1,050 seconds of bad. Leading up to Reagan's re-election run, the Institute for Applied Economics surveyed how the network news treated economic news during the strong recovery in the last half of 1983. It discovered that nearly 95% of the economic statistics were positive, yet 86% of the network's stories were primarily negative. Emmy Award winner Bernard Goldberg spent nearly 30 years with CBS News. His book Bias documents in detail how network television has provided one-sided news with little balance or fairness. This is a book all younger people in America should read. Goldberg tells how journalists decide what news they want to cover and the slant they want to impart. More damaging, they determine what news to minimize or keep quiet. They take sides and assign labels to people. MSNBC's Chris Matthews, a leading media figure, was a speechwriter for Jimmy Carter and an aide to House Speaker Tip O'Neill. Late Tim Russert of NBC was a political advisor to New York's former governor, Mario Cuomo. ABC's Jeff Greenfield was a speechwriter for Robert Kennedy. PBS's Bill Moyers was Lyndon Johnson's press secretary, and ABC News anchor George Stephanopoulos was Clinton's communications director. To succeed, both as individual investors and as a nation, we need to learn to separate facts from the personal political opinions and strong agenda-driven biases of the majority of the national media. This could be the number one problem in our country today. In addition to one-sided bias in the national media, freedom can be jeopardized by either infiltration or propaganda designed to undermine the nation and its people. This is intended to confuse national issues, pit one group against another, stir up class envy, fear, and hatred, and tear down or demean certain key people or established institutions. The most questionable practice of the one-sided media is how they select which stories and facts to cover and continually promote. Even more important are the critically relevant stories and facts they choose not to cover because those stories or facts don't support their agenda or the slant they want the story to have. In late 2008, public fear that the recession that was then underway might become like the Great Depression of 1929 and the 1930s escalated, and yet most Americans weren't even born then and know little about that period. There are three outstanding books about the 1930s and early 1940s every American should read. Since Yesterday, The 1930s in America by Frederick Lewis Allen gives a good account of what happened during that period. The Life and Death of Nazi Germany by Robert Goldstein covers Hitler and the rise of the Nazis from the late 1920s to the end of World War II in 1945. Masters of Deceit by former FBI Director J. Edgar Hoover covers how communism functions and operates. A well-informed and aware nation can protect and defend its freedoms. It's not like 1929, it's 1938. I've overlaid a chart of the NASDAQ Composite Index from the Anything Goes 1990s through March 2009, over the Dow Jones Industrials in the Roaring 1920s and the Depression era of the 1930s. They're almost exact duplicates. The NASDAQ was used because it trades more volume now than the NYSE and represents more entrepreneurial new America companies that have driven our markets in recent years. The NASDAQ from September 1998 to the wild peak in March 2000 actually soared 2.5 times the Dow's 1928-29 climax run-up. NASDAQ.com bubble was like the tulip bulb mania of 1636 in Holland. The NASDAQ declined 78%, whereas the Dow's 1929 crash declined 89%. The reason history repeats in this amazing manner is that the market is made up of millions of people acting almost 100% on human emotions. It's crowd psychology, human hopes, desires, fears, pride, and ego behind so many decisions. Human nature is pretty much the same today as it was in 1929. These two periods happened 70 years apart, about a lifetime. So, few people today know what happened then. Like now, the banks had excessive loans, then to farmers, plus stocks were bought on excessive leverage. Unemployment at the Depression lows in 1932 peaked at 25%, but was still 20% in 1939, just before World War II began. The rally from the 1932 low to the 1936-37 peak lasted the same amount of time as our NASDAQ recent rally back from the low of 2002 to 2007, and both fell around 50%. History is now on the march, but it's not like 1929, it's like 1938. So, what was happening in 1938? The Nazi Party in 1931, 107 seats in the Reichstag. Hitler became Chancellor of Germany in January 1933. He already had his stormtroopers, the Hitler Youth and other Nazi organizations. Only months later, the Reichstag gave Hitler all its constitutional powers, and by July all other political parties were outlawed. Hitler kept saying he was only interested in peace. By 1938, Britain and France negotiated with Hitler and tried to appease him by making concessions. Britain believed they had a peace agreement with Hitler, peace in our time. The crowds cheered. In Parliament, Churchill said, "We've suffered a defeat." No one believed him. He was booed. World War II began in 1939. Germany rolled over France in 2 weeks. Today, Iran is a sponsor of terrorist organizations and will have nuclear weapons very soon, plus the missile ability to deliver them. Have we learned anything from history in the 1930s? Will we repeat Neville Chamberlain's mistaken belief in an agreement on a piece of paper? I'm including 2 editorials by Thomas Sowell, whom I mentioned earlier in Chapter 16. His work always shows unexpected facts and wisdom. Roman Empire outlasted U.S., but it too fell. December 9, 2008, Thomas Sowell. Will the horrors unleashed by Islamic terrorists in Mumbai cause any second thoughts by those who are so anxious to start weakening the American security systems currently in place, including government interceptions of international phone calls and the holding of terrorists at Guantanamo? Maybe. But never underestimate partisan blindness in Washington or in the mainstream media, where, if the Bush administration did it, then it must be wrong. Contrary to some of the more mawkish notions of what a government is supposed to be, its top job is the protection of the people. Nobody on 9/11 would have thought that we would see nothing comparable again in this country for 7 long years. Many people seem to have forgotten how, in the wake of 9/11, every great national event, the World Series, Christmas, New Year's, the Super Bowl, was under the shadow of a fear that this was when the terrorists would strike again. They didn't strike again here, even though they have struck in Spain, Indonesia, England, and India, among other places. Does anyone imagine that this was because they didn't want to hit America again? Could this have had anything to do with all the security precautions that liberals have been complaining about so bitterly, from the interception of international phone calls to forcing information out of captured terrorists? Too many people refuse to acknowledge that benefits have costs, even if that cost means only having no more secrecy when making international phone calls than you have when sending emails, in a world where computer hackers abound. There are people who refuse to give up anything, even to save their own lives. A very shrewd observer of the deterioration of Western societies, British writer Theodore Dalrymple, said, "This mental flabbiness is decadence, and at the same time a manifestation of the arrogant assumption that nothing can destroy us." There are growing numbers of things that can destroy us. The Roman Empire lasted a lot longer than the United States has lasted, and yet it too was destroyed. Millions of lives were blighted for centuries thereafter, because the barbarians who destroyed Rome were incapable of replacing it with anything at all comparable. Neither are those who threaten to destroy the United States today. The destruction of the United States will not require enough nuclear bombs to annihilate cities and towns across America. After all, the nuclear destruction of just 2 cities was enough to force Japan to surrender, and the Japanese had far more willingness to fight and die than most Americans have today. How many Americans are willing to see New York, Chicago, and Los Angeles all disappear in nuclear mushroom clouds, rather than surrender to whatever outrageous demands the terrorists make? Neither Barack Obama nor those with whom he will be surrounded in Washington show any signs of being serious about forestalling such a terrible choice by taking any action with any realistic chance of preventing a nuclear Iran. Once suicidal fanatics have nuclear bombs, that is the point of no return. We, our children, and our grandchildren will live at the mercy of the merciless, who have a track record of sadism. There are no concessions we can make that will buy off hate-filled terrorists. They want what they must have for their own self-respect, in a world where they suffer the humiliation of being visibly centuries behind the West in so many ways. Is our being brought down in humiliation, including self-humiliation. Even killing us will not be enough, just as killing Jews was not enough for the Nazis, who first had to subject them to soul-scarring humiliations and dehumanization in their death camps. This kind of hatred may not be familiar to most Americans, but what happened on 9/11 should give us a clue and a warning. The people who flew those planes into the World Trade Center buildings could not have been bought off by any concessions, not even the hundreds of billions of dollars we are spending in bailout money today. They want our soul, and if they are willing to die and we are not, they will get it. False Solutions and Real Problems, March 17, 2009, Thomas Sowell. Someone once said that Senator Hubert Humphrey, liberal icon of an earlier generation, had more solutions than there were problems. Senator Humphrey was not unique in that respect. In fact, our present economic crisis has developed out of politicians providing solutions to problems that did not exist, and as a result, producing a problem whose existence is all too real and all too painful. What was the problem that didn't exist? It was a national problem of unaffordable housing. Political crusade for affordable housing got into high gear in the 1990s and led to all kinds of changes in mortgage lending practices, which in turn led to a housing boom and bust that has left us in the mess we are now trying to dig out of. Usually, housing affordability is measured in terms of how much of the average person's income it takes to cover either apartment rent or a monthly mortgage payment. There were certainly places here and there where it took half a family's income just to put a roof over their heads. Many such places were in coastal California, but there were a few others, here and there, on the East Coast and elsewhere. But vast areas of the country in between flyover country to the East Coast and West Coast elites had housing prices that took no larger share of the average American's income than in the decade before the affordable housing crusade got underway. Why then a national crusade by Washington politicians over local problems? Probably as good an answer as any is that it seemed like a good idea at the time. How are we to be kept aware of how compassionate and how important our elected officials are unless they are busy solving some problem for us? The problem of skyrocketing housing prices was all too real in those places where this problem existed. When you have to live on half your income because the other half goes for housing, that's a real downer. Almost invariably, these severe local problems had local causes, usually severe local restrictions on building homes. These restrictions had a variety of politically attractive names, ranging from open space laws and smart growth policies to environmental protection and farmland preservation. Like most wonderful-sounding political slogans, none of these lofty goals was discussed in terms of that one four-letter word that people do not use in polite political society: cost. No one asked how many hundreds of thousands of dollars would be added to the cost of an average home by open space laws, for example. Yet empirical studies have shown that land use restrictions added at least $100,000 to the average home price in dozens of places around the country. In some places, such as coastal California, these restrictions added several $100,000 to the price of the average home. In other words, where the problem was real, local politicians were the cause. National politicians then tried to depict this as a national problem that they would solve. How would they solve it? By pressuring banks and other lenders to lower their requirements for making mortgage loans so that more people could buy houses. Department of Housing and Urban Development gave the government-sponsored enterprise Fannie Mae quotas for how many mortgages it should buy that were made out for people with low to moderate incomes. Like most political solutions, the solution to the affordable housing problem took little or no account of the wider repercussions this would entail. Various economists and others warned repeatedly that lowered lending standards meant more risky mortgages. Given the complex relationships among banks and other financial institutions, including many big Wall Street firms, if mortgages started defaulting, all the financial dominoes could start falling. These warnings were brushed aside. Politicians were too busy solving a national problem that didn't exist. In the process, they created very real problems. Now they are offering even more solutions that will undoubtedly lead to even bigger problems. Chapter 18: How you could make your million owning mutual funds. What are mutual funds? A mutual fund is a diversified portfolio of stocks managed by a professional investment company, usually for a small management fee. Investors purchase shares in the fund itself and make or lose money based on the combined profits and losses of the stocks within the fund. When you purchase a mutual fund, what you're buying is long-term professional management to make decisions for you in the stock market. You should probably handle a mutual fund differently from the way you handle individual stocks. A stock may decline and never come back in price. That's why you must always have a loss-cutting policy. In contrast, a well-selected, diversified domestic growth stock fund run by an established management organization will, in time, always recover from the steep corrections that naturally occur during bear markets. The reason mutual funds come back is that they are broadly diversified and generally participate in each recovery cycle in the U.S. economy. How to become a millionaire the easy way. Mutual funds are outstanding investment vehicles if you learn how to use them correctly. However, many investors don't understand how to manage them to their advantage. The first thing to understand is that the big money in mutual funds is made by owning them through several business cycles, market ups and downs. This means 10, 15, 20, or 25 years or longer. Sitting tight for that long requires enormous patience and confidence. It's like real estate. If you buy a house, then get nervous and sell out after only 3 or 4 years, you may not make anything. It takes time for your property to appreciate. Here's how I believe you, as a shrewd fund investor, should plan and invest. Pick a diversified domestic growth fund that performed in the top quartile of all mutual funds over the last 3 or 5 years. It will probably have an average annual rate of return of about 15% or 20%. The fund should also have outperformed many other domestic growth stock funds in the latest 12 months. You'll want to consult a reliable source for this information. Many investment-related magazines survey fund performance every quarter. Your stockbroker or library should have special fund performance rating services so you can get an unbiased review of the fund you're interested in purchasing. Investors Business Daily rates mutual funds based on their 36-month performance records on a scale from a plus to E, and also provides other performance percentages based on different time periods. Focus your research on mutual funds with an A+, A, or a performance rating in IBD. During a bear market, growth fund ratings will be somewhat lower. The fund you pick does not have to be in the top 3 or 4 in performance each year to give you an excellent profit over 10 to 15 years. You should also reinvest your dividends and capital gains distributions, profits derived from a mutual fund's sales of stocks and bonds, to benefit from compounding over the years. The magic of compounding. The way to make a fortune in mutual funds is through compounding. Compounding occurs when your earnings themselves, the performance gains plus any dividends and reinvested capital, generate more earnings, allowing you to put ever greater sums to work. The more time that goes by, the more powerful compounding becomes. In order to get the most benefit from compounding, you'll need a carefully selected growth stock fund, and you'll need to stick with it over time. For example, if you purchase $10,000 of a diversified domestic growth stock fund that averages about 15% a year over a period of 35 years, here is an approximation of what the result might be. Compliments of the magic of compounding. First 5 years, $10,000 might become $20,000 next 5 years. $20,000 might become $40,000 next 5 years. $40,000 might become $80,000 next 5 years. $80,000 might become $160,000 next 5 years. $160,000 might become $320,000 next 5 years. $320,000 might become $640,000 next 5 years. $640,000 might become $1.28 million. Suppose you also added $2,000 each year and let it compound as well. Your total could then come to more than $3 million. Now, how much more do you think you'd have if you also bought a little extra during every bear market of 6 to 12 months, while the fund was temporarily down 30% or more from its peak? Nothing's guaranteed in this world, and yes, there are always taxes. However, this example is representative of how the better growth funds have performed over the last 50 years, and what could happen to you if you plan and invest in mutual funds correctly. Over any 20 to 25-year period, your growth fund should average 2 to 3 times what a savings account would return. It's definitely possible. When is the best time to buy a fund? Any time is the best time. You'll never know what the perfect time is, and waiting will usually result in your paying a higher price. You should focus on getting started and becoming regular and relentless about building capital that will compound over the years. How many funds should you own? As time passes, you may discover you'd like to develop an additional long-term program. If so, do it. In 10 or 15 years, you might have hefty amounts in 2 or even 3 funds. However, don't overdo it. There's no reason to diversify broadly in mutual funds. Individuals with multimillion-dollar portfolios could spread out somewhat further, allowing them to place sums into a more diverse group of funds. To do this correctly, you need to make some attempt to own funds with different management styles. For example, you could divvy up your money among a value-type growth fund, an aggressive growth fund, a mid to large cap growth fund, a small cap fund, and so on. Many fund organizations, including Fidelity, Franklin Templeton, American Century, and others, offer families of funds with varied objectives. In most cases, you have the right to switch to any other fund in the family at a nominal transfer fee. These families can offer you the added flexibility of making prudent changes many years later, are monthly investment plans for you. Programs that automatically withhold money from your paycheck are usually sound if you deposit that money in a carefully selected, diversified domestic growth stock fund. However, it's best to also make a larger initial purchase that will get you on the road to serious compounding all that much quicker. Don't let the market diminish your long-term resolve. Bear markets can last from 6 months to, in some rare cases, 2 or 3 years. If you're going to be a successful long-term investor in mutual funds, you'll need the courage and perspective to live through many discouraging bear markets. Have the vision to build yourself a great long-term growth program, and stick to it. Each time the economy goes into a recession, and the newspapers and TV are saying how terrible things are, consider adding to your fund when it's 30% or more off its peak. You might go so far as to borrow a little money to buy more if you feel a bear market has ended. If you're patient, the price should be up nicely in 2 or 3 years. Growth funds that invest in more aggressive stocks should go up more than the general market in bull phases, but they will also decline more in bear markets. Don't be alarmed. Instead, try to look ahead several years. Daylight follows darkness. You might think that buying mutual funds during periods like the Great Depression would be a bad idea because it would take you 30 years to break even. However, on an inflation-adjusted basis, had investors bought at the exact top of 1929, they would have broken even in just 14 years, based on the performance of the S&P 500 and the GIA. Had these investors bought at the top of the market in 1973, they would have broken even in just 11 years. If in addition, they had dollar-cost averaged throughout these bad periods, meaning they had purchased additional shares as the price went down, lowering their overall cost per share, they would have broken even in half the time. The 1973 drop in the Nasdaq from the peak of 137 would have been recovered in 3.5 years, and as of February 2009, the Nasdaq average had recovered from 137 to 1,300. Even during the 2 worst market periods in history, growth funds did bounce back, and they did so in less time than you'd expect. In other words, if you took the absolutely worst period of the 20th century, the Great Depression, and you bought at the top of the market, then dollar cost averaged down, at worst, it would have taken you 7 years to break even, and over the following 21 years, you would have seen your investment increase approximately 8 times. This is compelling evidence that dollar cost averaging into mutual funds and holding them for the long haul could be smart investing. Some people may find this confusing, since we have said that investors should never dollar cost average down in stocks. The difference is that a stock can go to zero, while a domestic, widely diversified, professionally managed mutual fund will find its way back when the market eventually gets better, often tracking near the performance of benchmarks like the S&P 500 and the Dow Jones Industrial Average. The super big gains from mutual funds come from compounding over a span of many years. Funds should be an investment for as long as you live. They say diamonds are forever. Well, so are your funds, so buy right and sit tight. Should you buy open or closed-end funds? Open-end funds continually issue new shares when people want to buy them, and they are the most common type. Shares are normally redeemable at net asset value whenever the present holders wish to sell. A closed-end fund issues a fixed number of shares. Generally, these shares are not redeemable at the shareholder's option. Redemption takes place through secondary market transactions. Most closed-end fund shares are listed for trading on exchanges. Better long-term opportunities are found in open-end funds. Closed-end funds are subject to the whims and discounts below book value of the auction marketplace. Should you buy load or no-load funds? The fund you choose can be a load fund, where a sales commission is charged, or a no-load fund. Many people prefer no loads. If you buy a fund with a sales charge, discounts are offered based on the amount you invest. Some funds have back-end loads, sales commissions that are charged when withdrawals are made, designed to discourage withdrawals, that you may also want to take into consideration when evaluating a fund for purchase. In any event, the commission on a fund is much less than the markup you pay to buy insurance, a new car, a suit of clothes, or your groceries. You may also be able to sign a letter of intent to purchase a specified amount of the fund, which may allow a lower sales charge to apply to any future purchases made over the following 13 months. Few people have been successful in trading no-load growth funds aggressively on a timing basis, using moving average lines and services that specialize in fund switching. Most investors shouldn't try to trade no-load funds because it's easy to make mistakes in the timing of buy and sell points. Again, get aboard a mutual fund for the long term. Should you buy income funds? If you need income, you will find it more advantageous not to buy an income fund. Instead, you should select the best fund available and set up a withdrawal plan equal to 1% per quarter, or 6% per year. Part of the withdrawal will come from dividend income received and part from your capital. If you selected the fund correctly, it should generate enough growth over the years to more than offset annual withdrawals of 6% of your total investment. Should you buy sector or index funds? Steer away from funds that concentrate in only one industry or area. The problem with these funds is that sectors go into and out of favor all the time. Therefore, if you buy a sector fund, you will probably suffer severe losses when that sector is out of favor or a bear market hits, unless you decide to sell it if and when you have a worthwhile gain. Most investors don't sell and could end up losing money, which is why I recommend not purchasing sector funds. If you're going to make $1 million in mutual funds, your fund's investments should be diversified for the long term. Sector funds are generally not a long-term investment. If you are conservative, it may be okay for you to pick an index fund, where the fund's portfolio closely matches that of a given index, like the S&P 500. Index funds have outperformed many actively managed funds over the long run. I tend to prefer growth funds. Should you buy bond or balanced funds? I also don't think most people should invest in bond or balanced funds. Stock funds generally outperform bond funds, and when you combine the two, you're ultimately just watering down your results. However, someone who is in retirement might want to consider a balanced fund if less volatility is desired. Should you buy global or international funds? These funds might provide some diversification, but limit the percentage of your total fund investment in this higher risk sector to 10%. International funds can, after a period of good performance, suffer years of laggard results, and investing in foreign governments creates added risk. Historically, Europe and Japan have underperformed the US market, the size problem of large funds. Asset size is a problem for many funds. If a fund has billions of dollars in assets, it will be more difficult for the fund manager to buy and sell large positions in a stock. Thus, the fund will be less flexible in retreating from the market or in acquiring meaningful positions in smaller, better-performing stocks. For this reason, I'd avoid most of the largest mutual funds. If you have one of the larger funds that's done well over the years, and it is still doing reasonably well despite having grown large, you should probably sit tight. Remember, the big money is always made over the long haul. Fidelity Contra Fund, run by Will Danoff, has been the best managed large fund for a number of years. Management fees and turnover rates. Some investors spend a lot of time evaluating a fund's management fees and portfolio turnover rates, but in most cases, such nitpicking isn't necessary. In my experience, some of the best performing growth funds have higher turnover rates. A portfolio turnover rate is the ratio of the dollar value of buys and sells during a year to the dollar value of the fund's total assets. Average turnover topped 350% in the Fidelity Magellan Fund during its 3 biggest performance years. CGM Capital Development Fund, managed by Ken Hebner, was the top-performing fund from 1989 to 1994. In 2 of those years, 1990 and 1991, it had turnover rates of 272% and 226%, respectively. and Huebner's superior performance even later in CGM Focus Fund was concentrated in 20 stocks that were actively managed. You can't be successful and on top of the market without making any trades. Good fund managers will sell a stock when they think it's overvalued, when they are worried about the overall market or a specific group, or when they find another, more attractive stock to purchase. That's what you hire a professional to do. Also, the institutional commission rates that funds pay are extremely low, only a few cents per share of stock bought or sold. So don't be overly concerned about turnover rates. It's the fund's overall performance over several years that is key. The 5 most common mistakes mutual fund investors make. 1. Failing to sit tight for at least 10 to 15 years. 2. Worrying about a fund's management fee, its turnover rate, or the dividends it pays. 3. Being affected by news in the market when you're supposed to be investing for the long term. 4. Selling out during bad markets. 5. Being impatient and losing confidence too soon. Other common mistakes. Typical investors in mutual funds tend to buy the best performing fund after it's had a big year. What they don't realize is that history virtually dictates that in the next year or two, that fund will probably show much slower results. If the economy goes into a recession, the results could be poorer still. Such conditions are usually enough to scare off those with less conviction and those who want to get rich quick. Some investors switch, usually at the wrong time, to another fund that someone convinces them is much safer or that has a hotter, recent performance record. Switching may be okay if you have a really bad fund or if you're in the wrong type of fund, but too much switching quickly destroys what must be a long-term commitment to the benefits of compounding. America's long-term future has always been a shrewd investment. The U.S. stock market has been growing since 1790, and the country will continue to grow in the future, in spite of wars, panics, and deep recessions. Investing in mutual funds, the right way, is one way to benefit from America's growth and to secure your and your family's long-term, 20-plus-year financial future. How to use IBD to buy ETFs. To be perfectly honest, I'm not a big fan of exchange-traded funds because I think you can make more money by focusing on the market leaders. But because ETFs had become so wildly popular with not only individual investors, but also asset managers, we started covering ETFs in February 2006. ETFs are basically mutual funds that trade like a stock, but offer transparency, tax efficiency, and lower expenses. While mutual funds set their prices or net asset value, NAV, once a day, the prices of ETFs jump and down throughout the day, just like a stock price. Anything you can do with a stock, you can do with an ETF, such as selling short and trading options. ETFs are more tax-friendly than mutual funds because of what happens under the hood. When market makers need to create or redeem shares, they round up the underlying stocks and trade them with the provider for new ETF shares. They do the opposite to redeem ETF shares for the underlying stocks. No money changes hands because the shares are traded in kind. Unlike mutual funds, ETFs are not affected by shareholder redemptions. If too many investors pull money out of mutual funds, fund managers may be forced to sell the stocks they hold to raise cash, thereby incurring a taxable event. ETFs keep trading to a minimum, so there are few taxable gains. ETFs charge management fees of anywhere from 0.10% to 0.95%. That's considerably smaller than those of mutual funds, which charge 1.02% on average. However, with a good mutual fund, you're getting a top-notch manager who makes investment decisions for you. An ETF requires that you pull the buy and sell triggers. Don't kid yourself that the diversification in an ETF will somehow protect you. Take the SPDR financial sector, XLF. In the banking meltdown in 2008, this ETF plunged 57%. The SPDR SPY, which tracks the S&P 500, was the first U.S.-listed ETF. It started trading on the Amex in 1993. The NASDAQ 100, known today as PowerShares QQQQ Trust QQQQ, and the Diamonds Trust DIA, which tracks the Dow Jones Industrial Average, were both launched in the late 1990s. Today, there are ETFs tracking not only benchmark indexes, but but also bonds, commodities, currencies, derivatives, carbon credits, investment strategies such as low P&E stocks, and more. In 2007 and 2008, ETF launches were what IPOs were to the internet bubble. Providers floated ETFs based on esoteric indexes that diced sectors into ridiculous slices such as Walmart suppliers, spin-offs, companies with patents, those that don't do any business with Sudan, and those engaged in sinful activities like gambling, alcohol, and tobacco. ETFs have changed the way many people trade, although not always for the better. They offer average investors access to foreign markets such as India, which limits foreign investors. They also let you trade commodities and currencies without having to open a separate futures or foreign exchange trading account. And the advent of inverse ETFs lets those with accounts that prohibit shorting to put on a short position by buying long. Since February 2004, ETFs have accounted for from 25% to as much as 44% of the monthly trading volume on the NYSE Arca. Top-down selection. IBD lists the 350 ETFs with the highest 50-day average volume and categorizes them by U.S., stock indexes, sector industry, global, bonds, fixed income, and commodities and currencies. Within each category, they're listed by our proprietary relative strength rating in descending order. Ranking ETFs by RS highlights the leaders within each category and helps you compare them. The tables also list year-to-date return, accumulation distribution rating, dividend yields, the prior day's closing price, the price change, and the change in volume versus the daily average. Aside from reading IB's ETF coverage, monitor the winners and losers table on the exchange-traded funds page. Every day we list the leaders and laggards over a given time period, which we rotate daily. Monday, 1 week percentage change Tuesday, 1 month percentage change Wednesday, 3 month percentage change Thursday, 6 month percentage change Friday, 12 month percentage change. Chapter 19. Improving the management of pension and institutional portfolios. Having managed individual accounts, pension funds, and mutual funds, as well as having dealt with many top portfolio managers, I have a few observations about professional money management. Individual investors need to know as much as they can about institutional money managers. After all, these managers represent the I in our can-slim formula and account for the majority of important price moves. They also exert far greater influence on prices than specialists, market makers, day traders, or advisory services do. I've learned from my grand share of mistakes in the past, and that's how all of us learn and become wiser about investing. Maybe my hands-on experience with all sides of the market through many economic cycles will offer some insights. However, I've never worked a day on Wall Street. That's probably a big plus. Institutional investors, an overview. The mutual fund you own, or the pension fund you participate in, is quarterbacked by an institutional money manager. You have a vested interest in knowing whether those managers are doing a good job, but understanding how they do their job is also of value. Today's markets are dominated by such pros, and most institutional buying is done with 100% cash rather than by using borrowed money margin. As a result, you might have a somewhat sounder foundation for most securities than you would if speculative margin accounts ruled our stock markets. For example, in 1929, the public was heavily involved in the market, speculating with 10% cash and 90% margin. This is one of the reasons why so many people got hurt when the market collapsed. They had too much debt. However, margin debt, as a percentage of the market capitalization of NYSE stocks, also reached an extreme level at the end of March 2000. Banks in 1929 also carried excessive mortgage debt. This time around, banks had lower quality mortgage debt. However, this lower quality debt was strongly pushed and pursued by our government, something the politicians don't want to admit as they investigate and try to blame everyone else rather than take responsibility for their own significant role in creating the subprime loan financial crisis. Professional investors usually do not panic as easily as the public can after prolonged declines. In fact, institutional buying support often comes in when prices are down. The severe problems the stock market encountered from 1969 to 1975 had nothing to do with institutional or public investors. They were the result of economic mistakes and bad policy decisions made by politicians in Washington, D.C. The stock market is like a giant mirror that reflects basic conditions, political management or mismanagement, and the psychology of the country. Stiff competition among money managers and close scrutiny of their performance records has probably made today's best institutional investment managers a little more proficient than they were 40 or 50 years ago. The first datagraph books evolve into Wunda. One of the first products we developed for institutional investors was the O'Neil database datagraph books, which contain extremely detailed charts on thousands of publicly traded companies. They were the first of their kind and represented an innovation in the institutional investment world. We were able to produce these books at timely weekly intervals, updating them at the market close every Friday. These comprehensive books were delivered to institutional money managers over the weekend in time for Monday's market open. This quick turnaround, for its time, was achieved not only because of the equity database we compiled and maintained on a daily basis, but also because of our high-speed microfilm plotting equipment. When we started out in 1964, this costly computer machinery was so new no one knew how to get a graph out of it. Once this barrier was cleared, it was possible to turn out complex, updated graphs through an automated process at the rate of 1 per second. Today, the technology has advanced so far that we can generate the most complex stock data graphs with hardly a second thought, and the O'Neil database books have become a mainstay at many of the leading mutual fund organizations around the globe. Initially, each data graph displayed price and volume information, along with a few technical and fundamental data items. Today, each data graph displays 96 fundamental and 26 technical items, and these are available for more than 8,000 stocks in 197 proprietary industry groups. This means an analyst or portfolio manager can quickly compare any company to any other, either in the same industry or in the entire database. We still offer the O'Neil database books, with their 600 pages of data graphs, to our institutional clients as part of our overall institutional investment business. With the advent of the internet and highly sophisticated computer technology, however, these old technology, hard copy books are being replaced by our newest and most innovative flagship service, Wunda. Wunda stands for William O'Neil Direct Access, and it provides all our institutional clients with a direct interface to the O'Neil database. The O'Neil database now contains more than 3,000 technical and fundamental data items on more than 8,000 U.S. stocks, and Wunda allows users to screen and monitor the database using any combination of these data items. We originally developed Wunda as an in-house system that we could use to manage our own money. In the 1990s, after years of real-time use, refinement, and upgrading, the service was rolled out as the newest William O'Neil + Co. service, available to the professional and institutional community. Because Wunda was conceived and created by our in-house portfolio managers and computer programmers, the service was designed with the serious institutional money manager in mind. Institutional money managers must frequently make rapid decisions while under fire during the market day, and Wunda offers a wide range of features that allows instantaneous access to and monitoring of crucial stock data and related information as the market is moving. Some of our institutional clients who use Wunda say they can practically print money with the system. These clients run the gamut from very conservative value-type managers to hedge fund managers. Clearly, no computer system can print money, but that type of comment from some of our biggest and best institutional clients points out the functionality and effectiveness of Wunda, interpreting Dome Petroleum's data graph. One of the secrets that you, as a winning individual investor, should never forget is that you want to buy a stock before its potential is obvious to others. When numerous research reports show up, it might actually be time to consider selling. If its value is obvious to almost everyone, it's probably too late. The accompanying data graph of Dome Petroleum has been marked up to highlight a few of the ways we interpret and use this display of fundamental and technical information. We suggested Dome to institutions in November 1977 at $48. Fund managers didn't like the idea, so we bought the stock ourselves. Dome became one of our biggest winners at that time. This and the following case studies are real-life examples of how it's actually done. The Pick and Save story. In July 1977, we suggested a stock that no institution would touch, Pick and Save. Most institutional managers felt the company was entirely too small because it traded only 500 shares a day, so we began purchasing it several months later. We had the successful historical computer models of Kmart in 1962, when it traded only 1,000 shares a day, and of Jack Eckerd Drug in April 1967, when it traded 500 shares a day. So we knew that, based on its excellent fundamentals and historical precedent, Pick and Save could become a real winner. Precedent was on our side. Both Kmart and Eckerd had become big winners in those early days after they were discovered, and average daily trading volume increased steadily as a result. The same thing occurred with Pick and Save. This little, unknown company, headquartered in Carson, California, turned in a steady and remarkable performance for 7 or 8 years. In fact, Pick and Save's pre-tax margins, return on equity, annual earnings growth rate, and debt-to-equity ratio were at that time superior to those of the other, more widely accepted institutional growth favorites, such as Walmart stores, that we had also recommended. I've always believed in finding an outstanding stock and buying it at every point on the way up. That's almost what happened with Pick and Save. We bought it almost every point or two on the way up for several years. I liked the company because it provided a way for families of meager means to buy most of the necessities of life at exceptionally low prices. All told, we bought Pick and Save on 285 different days and held it for 7.5 years. When we finally sold it, while it was still advancing, our sale did not affect the market. Our early purchases showed more than a 10-fold gain. Radio Shack's Charles Tandy. We first uncovered Tandy Corp. in 1967, but we were able to convince only 2 institutions to buy the stock. Among the reasons given for not buying it were that it didn't pay a dividend and that Charles Tandy was just a promoter. Qualcomm was another stock that was considered to be too promotional from 1996 to 1998. We picked it up straight off the weekly chart at the very end of 1998. It became the leading winner of 1999, advancing 20-fold. When I met Tandy in his office in downtown Fort Worth, Texas, my reaction was very positive. He was a brilliant financial man who also happened to be an outstanding salesman. He had innovative incentives, departmental financial statements, and highly detailed daily computer reports on sales of every item in every store by merchandise type, price, and category. His automated inventory and financial controls were almost unbelievable for that time. After the stock tripled, Wall Street analysts started to acknowledge its existence. There were even a few research reports noting Tandy as an undervalued situation. Isn't it strange how far some stocks have to go up before they begin to look cheap to everyone? The size problem in portfolio management. Many institutions think their main problem is size. Because they manage billions of dollars in assets, there never seem to be enough big capitalization stocks they can buy or sell easily. Let's face it, size is definitely an obstacle. It's easier to manage $10 million than $100 million. It's easier to manage $100 million than $1 billion. And $1 billion is a piece of cake compared to running $10 billion, $20 billion, or $30 billion. The size handicap simply means it's harder to buy or get rid of a huge stock holding in a small or medium-sized company. However, I believe it's a mistake for institutions to restrict their investments solely to large-cap companies. In the first place, there definitely aren't always enough outstanding ones to invest in at any given time. Why buy a slow-performing stock just because you can easily acquire a lot of it? Why buy a big-cap stock with earnings that are growing only 10% to 12% a year? If institutions limit themselves to large-cap investments, they could miss out on the truly powerful growth in the stock market. From 1981 to 1987, during the Reagan years, more than 3,000 dynamic, up-and-coming companies incorporated or had initial public offerings of stock. This was a first, and it was due mainly to several reductions in the capital gains tax during the early 1980s. Many of these small to medium-sized entrepreneurial concerns became enormous future market leaders and were responsible for driving the unprecedented technology boom and big expansion of new jobs in the 1980s and 1990s. Most of these names were small, unknown companies at the time, but you'll recognize them now as some of the biggest names and greatest winning companies of that period. This is just a partial list of the thousands of ingenious innovators that reignited growth in America until the March 2000 market top. Adobe Systems, Altera, America Online, American Power Conversion, Amgen, Charles Schwab, Cisco Systems, Clear Channel Communications, Compaq Computer, Converse Technology, Costco, Dell Computer, Digital Switch, EMC, Emulex, Franklin Resources, Home Depot. International Game Technology, Linear Technology, Maxim Integrated Products, Micron Technology, Microsoft, Novell, Novellus Systems, Oracle, PeopleSoft, PMC Sierra, Qualcomm, Sun Microsystems, United Health Group, US Healthcare, Veritas Computer, Vitus Semiconductor, Xilinx. As mentioned earlier, our government should seriously consider lowering the capital gains tax again and possibly shortening the time period to 6 months to help fuel a new cycle of entrepreneurial startup companies. Today's markets are more liquid than markets of the past, with the volume of many medium-sized stocks averaging 500,000 to 5 million shares a day. In addition, there is significant crossing of blocks between institutions, which also aids liquidity. The institutional manager who handles billions of dollars would be best advised to broaden his prospects to the 4,000 or more innovative companies that are available. This is better than restricting his activities to the same few hundred large, well-known, or legal list-type companies. At one point, the research department of one of the nation's largest banks followed only 600 companies. A sizable institution would probably be better off owning 500 companies of all sizes than 100 large, mature, slow-moving companies. However, mutual funds that concentrate in small-cap, big performers have to be more careful. If they have only a few $100 million to manage, this strategy might be quite rewarding. However, if these same funds, through their own success, grow to several $billion, they can't continue to concentrate solely in fast-moving, more speculative smaller names. The reason is that these stocks perform well in one phase and then later top. Some of them never come back or lag in performance for years. Several Janus and Putnam funds ran into this problem during the late 1990s and early 2000s period. Success can breed overconfidence. Pension funds can address size problems of their own by spreading their money among several different managers with different investment styles. Size is not the key problem. However, size isn't the number one problem for institutional investors. Frequently, it's their investment philosophies and methods that keep them from fully capitalizing on the potential of the market. Many institutions buy stocks based on their analysts' opinions about the supposed value of a company. Others mainly buy stories. Still others follow economists' top-down predictions of the broad sectors that ought to do well. Winning characteristics produces better results. In the past, some institutions used the same standard names for many years and rarely changed their approved lists. If a list had 100 widely accepted names, 4 or 5 might be added each year. Many decisions had to be approved by investment committees. However, market decisions made by committees are typically poor. To make matters worse, some committees had members who weren't experienced money managers. This is questionable investment policy. Even today, some institutions' investment flexibility is hamstrung by antiquated rules. Some more conservative institutions, for example, can't buy stocks that don't pay dividends. This seems right out of the dark ages, since many outstanding growth stocks deliberately don't pay dividends. Instead, they reinvest their profits in the company to continue funding their above-average growth. Other restrictions mandate that half or more of the portfolio be invested in bonds. Most bond portfolios have produced weak results over the long term. Also, in the past, some bond portfolios have used misleading accounting that did not value the portfolio at current market prices. In these situations, portfolio results are reported too infrequently, and the true overall performance is unclear. There is too much emphasis on yield and not enough on the increase or decrease in the market value of the assets in the portfolio. The main problem is that most of these antiquated, institutionally accepted investment decision processes have a deeply rooted legal basis. They have become, in a word, institutionalized. Many institutions are forced to adhere to legal concepts such as due diligence and fiduciary responsibility when they make investment decisions. In most cases, a trust department can be held liable for poor or derelict investment decisions. But the standard for determining whether an investment decision is poor or derelict has nothing to do with the performance of the investment itself. If an institution can show that the selection of a stock it decided to invest in was based on the old prudent man rule, meaning the institution acted as a prudent man or woman would be expected to act when dealing with his or her own money, that it took into account valuation based on a static view of a company's fundamental situation, or that it was part of an overall asset allocation model or some other similar reason arrived at by due diligence, then the institution can show it exercised its fiduciary responsibility properly, and thus sidestep any liability. Years ago, institutions had relatively few fund managers to choose from, but today there are many outstanding professional money management teams using a variety of systems. However, many managers can't buy a stock that's not on a pre-approved list unless it's accompanied by a long, glowing report from one of the institution's analysts. Since the institutions already own a substantial number of companies that they insist their analysts continue to follow and update, it might take an analyst more time to get interesting new names onto an approved list and reports prepared on these companies. Superior performance comes from fresh ideas, not from the same old overused, stale names or last cycle's favorites. For example, the super tech leaders of 1998 and 1999 will probably be replaced by many new consumer and defense sector leaders in the 21st century. Bottom buyer's bliss. Many institutions buy stocks on the way down, but bottom fishing isn't always the best way to achieve superior performance. It can place decision makers in the position of buying stocks that are slowly deteriorating or whose growth is decelerating. Other money management organizations use valuation models that restrict investments to stocks in the lower end of their historical P/E ranges. This approach works for a number of unusually capable, conservative professionals, but over time, it rarely produces truly superior results. Several major Midwest banks that use this approach have continually lagged in performance. Entirely too many analysts have a P/E hang-up. They want to sell a stock with a P/E that's up and looks high and buy one when its P/E comes off. 50 years of models of the most successful stocks show that low or reasonable P/Es are not a cause of huge increases in price. Those who were faithful to low P/Es probably missed almost every major stock market winner of the last half-century. Most of those who concentrate on the undervalued theory of stock selection may lag today's better managers. Sometimes these undervalued situations get more undervalued or lag the market for a long time. In the market free fall in late 2008 and early 2009, I noticed several value funds that were down about as much as some of the growth funds, which is unusual. Comparing growth versus value results. Over the previous 12 business cycles, it's been my experience that the very best money managers during a cycle produced average annual compounded total returns of 25% to, in a few rare cases, 30%. This small group consisted of either growth stock managers or managers whose most successful investments were in growth stocks plus a few big turnaround situations. The best undervalued type managers in the same period averaged only 15% to 20%. A few had gains of over 20%, but they were in the minority. Most individual investors haven't prepared themselves well enough to average 25% or more per year, regardless of the method used. Value funds will do better in down or poor market periods. Their stocks typically haven't gone up a large amount during the prior bull market periods, and so they typically will correct less. Therefore, most people who are trying to prove the value case will pick a market top as the beginning point of a 10 or more year period during which to to compare value with growth investing. This leads to an unfair comparison in which value investing may prove more successful than growth stock investing. The reality is that if you look at the situation fairly, growth stock investing usually outperforms value investing over most periods. Value line dumps the undervalued system. From the 1930s up to the early 1960s, the Value Line service rated the stocks it followed as undervalued or overvalued. The company's results were mediocre until it dumped the system in the 1960s and began rating stocks based on earnings increases and relative market action. After the switch, Value Line's performance improved, overweighting and underweighting relative to the S&P. Many institutions invest primarily in stocks that are in the S&P 500 and try to overweight or underweight their positions in certain sectors. This practice ensures they'll never do much better or much worse than the S&P 500. However, an outstanding small-cap or mid-cap growth stock manager should potentially be able to average about 1.25 to 1.5 times the S&P 500 over a period of several years. The S&P 500 is a tough index for a mutual fund to materially beat because the S&P is really a managed portfolio that continues to add newer, better companies and discard laggards. Another way to outperform the S&P is to buy superior new growth stocks or stocks that are not in the S&P. Weaknesses of the industry analyst system. Another widely used but expensive and ineffective practice is to hire a large number of analysts and then divvy up coverage by industry. Some of this is done for the investment banking side in order to develop and maintain client relationships. Thus, at a minimum, analysts have in the past had split loyalties. The typical securities research department has an auto analyst, an electronics analyst, an oil analyst, a retail analyst, a drug analyst, and on and on. But this setup is not efficient and tends to perpetuate mediocre performance. What does an analyst who is assigned 2 or 3 out of favor groups do? Recommend the least bad of all the poor stocks she follows. On the other hand, the analyst who happens to follow the year's best performing group may recommend only 2 or 3 winners, missing many others. When the oil stocks boomed in 1979 and 1980, all of them doubled or tripled. The best shot up 5 times or more. The theory behind dividing up research is that this allows a person to be an expert on a particular industry. In fact, Wall Street firms will go so far as to hire a chemist from a chemical company to be their chemical analyst and a Detroit auto specialist to be their automotive analyst. These individuals may know the nuts and bolts of their industries, but in many cases, they have little understanding of the general market and what makes leading stocks go up and down. Maybe this explains why virtually every analyst appearing on CNBC after September 2000 continued to recommend buying high-tech stocks as they were on their way to 80% to 90% declines. People lost a lot of money if they followed this free advice on TV. A similar repeat performance occurred in 2008 when fundamental analysts recommended buying oils and banks on their way down because they looked very cheap. They then got a lot cheaper. Firms also like to advertise they have more analysts, the largest department, or more top-ranked all-star analysts. I'd rather have 5 good analysts who are generalists than 50, 60, or 70 who are confined to limited specialties. What are your chances of finding 50 or more analysts who are all outstanding at making money in the market or coming up with money-making ideas? The shortcomings of Wall Street analysts were never made plainer to institutional and individual investors than during the 2000 bear market. While the market continued to sell off in what would at the time become the worst bear market since 1929, as measured by the percentage decline in the Nasdaq index, and while many former high-flying tech and internet stocks were being decimated, Wall Street analysts continued to issue buy or strong buy recommendations on these stocks. In October 2000, one major Wall Street firm was running full-page ads calling the market environment at that time one of the 10 best times to own stocks in history. As we now know, the market continued to plummet well into 2001 and 2002, making that period one of the worst times in history to own stocks. It was not until many of the tech and internet high flyers were down 90% or more from their peaks that these analysts finally changed their tune. Many days late and many dollars short. A December 31, 2000, New York Times article on analysts' recommendations quoted Zacks investment research as follows. Of the 8,000 recommendations made by analysts covering the companies in the Standard & Poor's 500 stock index, only 29 now are sells. In the same article, Arthur Levitt, chairman of the Securities and Exchange Commission, stated, "The competition for investing banking business is so keen that analysts sell recommendations on stocks of banking clients are very rare." A mutual fund manager quoted by the Times said, "What passes for research on Wall Street today is shocking to me." Instead of providing investors with the kind of analysis that would have kept them from marching over the cliff, analysts prodded them forward by inventing new valuation criteria for stocks that had no basis in reality and no standards of good practice. Vanity Fair also ran an interesting article on the analytical community in August 2001. Clearly, at no time in the history of the markets has the phrase caveat emptor had more meaning for investors, both institutional and individual alike. The implementation of SEC Rule FD, governing the fair disclosure of material company information to both institutional and individual investors, in 2000, has restricted the ability of major brokerage research analysts to receive inside information from a company before it is released to the rest of the street. This has further reduced any advantage that can be gained by listening to most Wall Street analysts. We prefer to deal only with facts and historical models rather than opinions about supposed values. Many research analysts in 2000 and 2001 had not been in the business for 10 years or longer, and therefore had never experienced the terrible bear markets of 1987, 1974 to 1975, and 1962. On still another subject, many large money management groups probably deal with entirely too many research firms. For one thing, there aren't that many strong research inputs, and dealing with 20 or 30 firms dilutes the value and impact of the few good ones. Confusion, doubt, and fear created by conflicting advice at critical junctures can prove to be expensive. It would be interesting to know how many analysts have been highly successful in their own investments. This is the ultimate test, Financial World's startling survey of top analysts. A Financial World magazine article dated November 1, 1980, also found that the analysts selected by Institutional Investor magazine as the best on Wall Street were overrated and overpaid, and that they materially underperformed the S&P averages. As a group, the superstar analysts failed on 2 out of 3 stock picks to match either the market as a whole or their own industry averages. They also seldom provided sell recommendations, limiting most of their advice to buys or holds. The Financial World study confirmed research we performed in the early 1970s. We found that only a minority of Wall Street recommendations were successful. We also concluded that during a period in which many sell opinions were in order, just 1 in 10 reports made a sell suggestion. One problem is that a lot of the research on Wall Street is done on the wrong companies. Every industry analyst has to turn out a certain amount of product, but only a few industry groups lead a typical market cycle. There's insufficient front-end screening or control to determine the superior companies on which research reports should actually be written. Database power and efficiency. On any given day, most institutional money managers receive a stack of research reports a foot high. Trudging through them in search of a good stock is usually a waste of time. If they're lucky, they may spot 1 in 20 that's really right to buy. In contrast, those with access to Wanda can rapidly screen all the companies in our database. If the defense industry pops up as one of the leading industries, they can call up 84 different corporations whose primary business is in that area. The typical institution might look at Boeing, Raytheon, United Technologies, and 2 or 3 other big, well-known names. Since Wanda provides more than 3,000 technical and fundamental variables on each of the 84 companies stretching back a number of years, as well as the ability to display these variables quickly on identical graphic displays, It's possible for an institutional money manager to identify in 20 minutes the 5 or 10 companies in the entire group that have outstanding characteristics and are worthy of more detailed research. It's a vital time saver some of America's very best money managers relentlessly use. In other words, there are ways for an institution's analysts to spend their time far more productively. Yet few research departments are organized to take advantage of such advanced and disciplined procedures. How well has this approach worked? In 1977, we introduced an institutional service called New Stock Market Ideas and passed leaders to avoid NSMI. Now titled New Leaders and Laggards Review, it is published every week, and its documented 30-year long-term performance record is shown on the accompanying graph. These performance returns were audited and verified by one of the top independent accounting firms in America. Then 307 to 1, and the positive picks over 30 years outran the S&P 500 stocks more than 41-fold. The compounding over the 30 years' time helps make a superior long-term record like this possible. For the 30 years ended 2008, stocks listed as stocks to avoid made a teeny 19% gain for the entire 30 years. Institutions could have dramatically improved their performance just by staying out of all the stocks on our avoid list. As a service to our institutional clients, we provide them with computerized quarterly performance reports for every buy and avoid suggestion made in the New Stock Market Ideas service. How many competing firms provide the actual percent performance of all their ideas over an extended period? By having a massive amount of factual data on every firm and proven historical precedent chart models over more than 100 years, we're able to discover a stock that's beginning to improve or get in trouble much earlier, without ever visiting or talking to the company. It may be naive to believe companies are always going to tell you when they are beginning to have problems. By using our own factual data and historical research, we also discourage any reliance on tips, rumors, and analysts' personal opinions. We just don't need such information. We also do not have investment banking clients or market-making activities. Nor do we manage money for other people or hire any research analysts to prepare written research reports, so those areas of potential bias or underperformance are non-existent. The 1982 and 1978 full-page bullish ads. We usually don't try to call every short-term or intermediate correction. For institutional investors, this would be a little foolish and short-sighted. Our primary focus is on recognizing and acting upon the early stages of each new bull and bear market. This work includes searching for the market sectors and groups that should be bought and those that should be avoided. In early 1982, we placed a full-page ad in the Wall Street Journal stating that the back of inflation had been broken and the important stocks had already made their lows. That May, we mailed out 2 wall charts to our institutional clients, one of defense electronics stocks and the other of 20 consumer growth stocks we thought might be attractive for the bull market ahead. We also made a point of going to New York and Chicago to meet with several large institutions. In these meetings, we stated our bullish posture and provided a list of names that could be purchased after these organizations did their due diligence. The stance we took was diametrically opposed to the position of most institutional research firms at that time, as well as to the negative news flooding out of the national media each day. Most investment firms were downright bearish. They anticipated another big down leg in the market. They also projected that interest rates and inflation were going to soar back to new highs as a result of massive government borrowing that would crowd the private sector out of the marketplace. The fear and confusion created by these questionable judgments frightened large investors so much that they hesitated. As a result, they did not fully capitalize on the fact that we had already identified the 2 leading groups for the coming bull market. It appeared professional managers had been bombarded with so much negative expert Wall Street input that they found our positive findings hard to believe. As for us, we invested fully on margin in the summer of 1982 and enjoyed our best performance ever up to that time. From 1978 to 1991, our account increased 20-fold. From the beginning of 1998 through 2000, our firm's account, run out of our separate holding company, increased 1,500%. Results such as this remind us it may be an advantage not to be headquartered in rumor-filled and emotion-packed Wall Street. I have never worked one day on Wall Street in my entire time in the investment field. As a savvy individual investor, you have a gigantic advantage in not having to listen to 50 different, strongly held opinions. You can see from this example that majority opinions seldom work in the market, and that stocks seem to require doubt and disbelief, the proverbial wall of worry, to make meaningful progress. The market generally moves to disappoint the majority. Our first full-page ad in the Wall Street Journal was placed in March 1978. It predicted a new bull market in small to medium-sized growth stocks. We had written the ad weeks ahead of time and waited to run it until we felt the time was right. The right time came when the market was making new lows, which caught investors by surprise. Our only reason for placing the ad was to document in print exactly what our position was at that juncture, so that institutional investors could have no question about it later on. It is at these extremely difficult market turning points that an institutional firm can be of most value. At such times, many people are either petrified with fear or carried away with excessive fundamental information. Our institutional historical precedent firm has more than 500 leading institutional accounts in the United States and around the world. We were one of the few firms to tell its accounts they should avoid or sell tech stocks and raise cash in March, April, and September 2000. Institutional investors are human. If you don't think fear and emotion can ride high among professional investors after a prolonged decline, think again. I remember meeting with the top 3 or 4 money managers of one important bank at the bottom of the market in 1974. They were as shell-shocked, demoralized, and confused as anyone could possibly be. They deserved to be. The ordinary stock in the market at that time was down 75%. About the same time, I recall visiting with another top manager. He too was thoroughly worn out and, judging from the peculiar color of his face, suffering from market sickness. Yet another top fund manager in Boston looked as if he'd been run over by a train. Of course, all of this is preferable to 1929, when some people jumped out of office buildings in response to the devastating market collapse. I also recall a high-tech seminar given in 1983 in San Francisco, attended by 2,000 highly educated analysts and portfolio managers. Everyone was there, and everyone was ebullient and self-confident, and that marked the exact top for high-tech stocks. I also remember a presentation we gave to a bank in another large city. All its analysts were brought in and sat around an impressive table in the boardroom, but not one analyst or portfolio manager asked any questions during or after the presentation. It was the strangest situation I've ever been in. Needless to say, this institution consistently performed in the lower quartiles, compared to its more alert and venturesome competitors. It's important to communicate and be open to new ideas. Years ago, one medium-sized bank for which we did consulting work insisted we give them recommendations only from among the stocks it carried on its limited approved list. After consulting with the bank's managers each month for 3 months and telling them that there was nothing on their approved list that met our qualifications, we had to honorably part company. A few months later, we learned that key officials in that trust department had been relieved of their jobs as a result of their laggard performance. We provided product to another Midwest institution, but it was of doubtful value because the institution had a cast in concrete belief that any potential investment had to be screened to see if it passed an undervalued model. The best investments rarely show up on any undervalued model, and there's probably no way this institution will ever produce first-rate results until it throws out the model. This isn't easy for large organizations to do. It's like asking a Baptist to become a Catholic or vice versa. Some large money management organizations with average records tend to fire the head of the investment department and then look for a replacement who invests pretty much the same way. Naturally, this doesn't solve the problem of deficient investment methods and philosophy. Security Pacific Bank in Los Angeles was an exception to this rule. In July 1981, it made a change in its top investment management. It brought in an individual with a completely different approach, a superior investment philosophy, and an outstanding performance record. The The results were dramatic and were accomplished almost overnight. In 1982, Security Pacific's Fund G was ranked #1 in the country. Penny wise and performance foolish. Some corporations put too much emphasis on saving management fees, particularly when they have giant funds to be managed. It's usually an actuary who convinces them of the money their pension fund can save by shaving the fee by 1/8 of 1%. If corporations have billions of dollars to be managed, it makes sense for them to increase their fees and incentives so they can hire the best money managers in the business. The better managers will earn the extra 0.25% or 0.50% 10 or 20 times over. The last thing you ever want is cheap advice in the stock market. If you were going to have open heart surgery, would you look for the doctor who will charge the absolute least? How to select and measure money managers properly. Here are a few tips for corporations and organizations that want to farm out their funds to several money managers. In general, portfolio managers should be given a complete cycle before their performance is reviewed for the purpose of deciding whether to change managers. Give them from the peak of one bull market period to the peak of another cycle, or from the trough of one cycle to the trough of another. This will usually cover a 3 or 4 year period and will allow all managers to go through both an up market and a down market. At the end of this period, the bottom 20% or so of the managers in total overall performance should be replaced. Thereafter, every year or two, the bottom 5% or 10% of managers over the most recent 3 or 4 year period should be dropped. This avoids hasty decisions based on disappointing performance over a few short quarters or a year. Given time, this process will lead to an outstanding group of proven money managers. Because this is a sound, longer-term, self-correcting mechanism, it should stay that way. Then it won't be necessary to pay as many consultants to recommend changes in personnel. In the selection of managers, consideration should be given to their latest 3 to 5 year performance statistics, as well as to a more recent period. Diversification among the types, styles, and locations of managers should be considered. The search should be widespread and not necessarily limited to one consultant's narrow, captive universe or stable of managers. The corporate or pension fund client with money to be managed also has to be careful not to interfere at critical junctures, deciding, for example, when a greater proportion of the portfolios should be either in stocks or in bonds, or that undervalued stocks should be emphasized. Cities and counties that have funds to invest must be very careful, because few of their personnel are highly experienced in the investment field. These inexperienced people can easily be talked into investing in bonds that are promoted as being safe, but that later can cause enormous losses. This happened, of course, in 2008 with AAA subprime loans in real estate mortgage packages. Clients can also interfere by directing where commissions should go or insisting that executions be given to whoever does them most cheaply. The latter, while a well-meaning attempt to save money, commonly results in forcing upon a money manager someone who provides either poorer executions or no research input of real value. This handicap costs the portfolio money, as it pays a half point or more, or its decimal equivalents on trades that are executed by less experienced people. Is an index fund the way to go? Finally, a word about the indexing of equity portfolios. There's an assumption that a pension fund's objective is to match the performance of some general market index. This theoretically could be a risky conclusion. If we were to go through another 1929 market collapse, and the general market indexes were to decline 90% in value, no intelligent trustee could possibly believe his fund's objective should be to lose 90% of its value. No one will be happy just because the fund achieved its target of matching the index's disastrous performance. I saw a small version of this happen in 1974 when I was called in to evaluate a fund that had lost exactly 50% of its assets because it was managed by an organization that specialized in and promoted index funds. People were very upset, but they were too embarrassed to state their conclusion publicly. Why should anyone expect the majority of money managers to be any better at their jobs than the majority of musicians, ball players, doctors, teachers, artists, or carpenters are at theirs? The fact of the matter is that the typical person in a given field may be slightly subpar. The answer in money management is the same as in other occupations. To get above average results, you have to go out of your way to find the minority of managers who can beat the market indexes fairly consistently. Some people will say this is impossible, but that's simply not true. To say that all information is already known, that stocks can't be selected in a way that outperforms market averages, is nonsense. Value Line's rating system since 1965 is ample evidence that stocks can be selected in a way that materially outperforms the market. Our own top datagraph-rated stocks have dramatically outperformed the market. During a sabbatical at the University of Chicago, Professor Mark Rhein-Ganem of the University of Iowa, and later of Southern Methodist University, conducted an independent research study titled Selecting Superior Securities. For his research, he picked 9 variables comparable to those discussed in this book and achieved a 1984-1985 result that was 36.7% greater than the S&P 500. He's not alone. We've now received more than 1,000 testimonials from investors who also have materially outperformed the market indexes. Those who say the stock market is a random walk are sadly misinformed. There are a number of systems and services that can and do outperform the market. Unfortunately, there are also too many poorly based opinions, too many faulty interpretations, and too many destructive emotions that come into play. Sometimes judgments are just bad or shallow. Sometimes there are too many complex variables. Sometimes events change too fast to keep up with. And finally, there are just too many fundamental and technical research reports recommending mediocre stocks on their way down. That's why sell recommendations are few and far between when each bear market begins. In the future, the indexing of a small part of Social Security investments may eventually be possible if rules can be created to keep the government away from influencing any of the investment decisions. After all, the rather poor existing Social Security investments do not even keep up with inflation over any long-term period of 20 years. You can see that even the pros need to evaluate what they're doing and alter their preconceived methods if they aren't working. We all make mistakes, but the answer is to learn what's working once you see what's not. History will give you solid examples that should guide you in your investing. Only by careful study and research, and by not accepting conventional wisdom, have we uncovered these valuable findings. Use them and profit. You can make it happen. Study the 100 examples in Chapter 1 carefully so you will better know what to look for in the future. Chapter 20. Important rules and guidelines to remember. 1. Don't buy cheap stocks. Buy mainly NASDAQ stocks selling at between $15 and $300 a share and NYSE stocks selling from $20 to $300 a share. The majority of super stocks emerge from bases of $30 and up. Avoid the junk pile below $10. 2. Buy growth stocks where each of the last 3 years' annual earnings per share have been up at least 25%, and the next year's consensus earnings estimate is up 25% or more. Many growth stocks will also have annual cash flow of 20% or more above EPS. 3. Make sure the last 2 or 3 quarters' earnings per share are up a huge amount. Look for a minimum of 25% to 30%. In bull markets, look for EPS up 40% to 500%. The higher, the better. 4. See that each of the last 3 quarters' sales are accelerating in their percentage increases, or the last quarter's sales are up at least 25%. 5. Buy stocks with a return on equity of 17% or more. The great companies will show a return on equity of 25% to 50%. 6. Make sure the recent quarterly after-tax profit margins are improving and are near the stock's peak after-tax margins. 7. Most stocks should be in the top 6 or so broad industry sectors in IBD's daily new price highs list, or in the top 10% of IBD's 197 industry subgroup rankings. 8. Don't buy a stock because of its dividend or its P/E ratio. Buy it because it's the number 1 company in its particular field in terms of earnings and sales growth, ROE, profit margins, and product superiority. 9. Buy stocks with a relative price strength rating of 85 or higher in Investors Business Daily's SmartSelect ratings. 10. Any size capitalization will do, but the majority of your stocks should trade an average daily volume of several 100,000 shares or more. 11. Learn to read charts and recognize proper bases and exact buy points. Use daily and weekly charts to materially improve your stock selection and timing. Long-term monthly charts can help too. Buy stocks when they initially break out of sound and proper bases with volume for the day 50% or more above normal trading volume. 12. Carefully average up, not down, and cut every single loss when it is 7% or 8% below your purchase price, with absolutely no exceptions. 13. Write out your sell rules that determine when you will sell and nail down a worthwhile profit in your stock. 14. Make sure that at least one or two better performing mutual funds have bought your stock in the last reporting period. You also want your stocks to have increasing institutional sponsorship over the last several quarters. 15. The company should have an excellent, new, superior product or service that is selling well. It should also have a big market for its product and the opportunity for repeat sales. 16. The general market should be in an uptrend and be favoring either small or big cap companies. If you don't know how to interpret the general market indexes, read IBD's The Big Picture column every day. 17. Don't mess around with options, stocks that trade in foreign markets, bonds, preferred stocks, or commodities. It doesn't pay to be a jack of all trades, or to over-diversify or engage in too much asset allocation. Either avoid options outright or restrict them to 5% or 10% of your portfolio. 18. The stock should have ownership by top management. 19. Look mainly for new America entrepreneurial companies, those with a new issue within the last 8 or 10 years, rather than too many laggard, old America companies. 20. Forget your pride and your ego. The market doesn't care what you think or want. No matter how smart you think you are, the market is always smarter. A high IQ and a master's degree are no guarantee of market success. Your ego could cost you a lot of money. Don't argue with the market. Never try to prove you're right and the market is wrong. 21. Read Investor's Corner and The Big Picture in IBD Daily. Learn how to recognize general market tops and bottoms. Read up on any company you own or plan to buy. Learn its story. 22. Watch for companies that have recently announced they are buying back 5% to 10% or more of their common stock. Find out if there is new management in the company and where it came from. 23. Don't try to buy a stock at the bottom or on the way down in price, and don't average down. If you buy the stock at $40, don't buy more if it goes down to $35 or $30. Key reasons people miss buying big winning stocks. 1. Disbelief, fear, and lack of knowledge. Most big winners are newer companies with IPOs in the last 8 or 10 years. Everyone knows Sears and General Motors, but most people are simply unaware of or unfamiliar with the hundreds of new names that come into the market every year. The new America names are the growth engine of America, creating innovative new products and services, plus most of the new technology. A chart service is one easy way to at least be aware of the basics of price, volume, sales, and earnings trends of all these compelling younger companies. 2. P&E bias. Contrary to conventional wisdom, the best stocks rarely sell at low P&Es. Just as the best ballplayers make the highest salaries, the better companies sell at better, higher P&Es. Using P&Es as a selection criterion will prevent you from buying most of the best stocks. 3. Not understanding that the real leaders start their big moves by selling near or at new price highs, not near new lows or off a good amount from their highs. Investors like to buy stocks that look cheap because the stocks are lower than they were a few months ago, so they buy stocks on the way down. They think they are getting bargains. They should be buying stocks that are on the way up, just making new price highs as they break out of a proper base or price consolidation area. 4. Selling too soon, either because they get shaken out or because they are too quick to take a profit, and psychologically having a hard time buying back a stock at a higher price if necessary. They also sell too late, letting a small loss turn into a devastating one by not cutting all their losses at 8%. One final thought. You can definitely become financially independent once you learn to save and invest properly. My parting advice: have courage, be positive, and don't ever give up. Great opportunities occur every year in America. Get yourself prepared, study, learn, and go for them. What you'll find is that little acorns can grow into giant oaks, and that with persistence and hard work, anything is possible. You can do it, and your own determination to succeed is the most important element. Success in a free country is simple. Get a job, get an education, and learn to save and invest wisely. Anyone can do it. You can do it.